Good morning. I'm Julie Hyman alongside Inez Ferre in for Brad Smith today. This is Yahoo Finance Live. And today is International Women's Day. We're celebrating the day by featuring women guests across all sectors, CEOs, activists, politicians, and economists. Our goal at Yahoo Finance every day is to bring you diverse voices that reflect our diverse society and to normalize seeing smart people of all stripes talking about business and finance. And speaking of business and finance, let's get right to the three things you need to know to start off your morning. That guy right there. First thing you need to know, Fed Chair Jerome Powell. He heads back to Capitol Hill today for his second day of hearings. And so far, he made it clear that the central bank is prepared to aggressively raise interest rates in order to tame stubborn inflation. Stocks skidded on the news and bond yields surged. The two-year U.S. Treasury yield went above 5% for the first time since 2007. A closely watched part of the yield curve saw its deepest inversion in over 40 years. What does that mean? Some economists consider that a recession indicator. Second thing you need to know, the White House has set the stage for a TikTok ban. The Biden administration has backed a bill that could give the president the power to ban the social media app in the U.S. The legislation was introduced yesterday by Senators Mark Warner and John Thune. And this move comes as concerns rise around the app doubling as a way to spy on Americans. Meanwhile, a TikTok executive in Europe this morning is reacting to similar concerns there with new data protection measures. Third thing you need to know, Adidas grappling with the Yeezy fallout. The athletic apparel giant stuck with $1.3 billion of unsold merchandise after ending its partnership with Ye, of course formerly known as Kanye West. Today it posted a loss of more than 700 million euros and slashed its dividend. Adidas' new CEO floated several possibilities for all that Yeezy gear, including maybe selling it and donating the proceeds to charity. Well, Fed Chair Jerome Powell raised the possibility of bigger interest rate hikes as the central bank looks to tackle stubborn inflation. His hawkish comments were made at a hearing on Capitol Hill yesterday.
Inflationary pressures are running higher than expected at the time of our previous FOMC meeting. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Congress really needs to raise the debt ceiling. That's the only way out.
You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. We are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Well, that gives you a little summary. Set to music with what we heard from Powell. That was before the Senate Banking Committee, as you saw Senator Elizabeth Warren there questioning Powell. He's heading back to Capitol Hill today for the second round of hearings before the House Financial Services Committee. And Inez, in the wake of his comments yesterday, we've seen a number of banks raise their rate estimates, not necessarily for the meetings incrementally, but the terminal rate, as it's called, the place where the Fed is going to end up.
Yeah, and one of them being Goldman Sachs, basically saying that Powell's testimony is pointing to higher terminal rate, and that opens the door to faster hiking pace. So Goldman Sachs raising its terminal rate forecast to 5.5 to 5.75%. The Fed policy rate right now is currently at 4.5 to 4.75, and it's 7.5%, that range. But certainly it's significant that Goldman has increased its forecast for the terminal rate. It's significant that banks are sort of forecasting like, well, could Powell, could the Fed increase rates by 50 basis points at the next meeting? We had thought it would be 25 basis points. There's a debate going on whether whether or not it will be 50, it will be 25. Citi is actually fading the 50 basis point hike narrative, saying that we like to fade the 50 basis point hike narrative. As in our view, it would essentially mean that the Fed is giving up on a soft landing. And that goes in part with what Jerome Powell was saying yesterday as well, when he was really being pressed about the unemployment. So unemployment has to go up. So people have to lose their jobs. You're saying 2 million people have to lose their jobs. So by them raising by 50 basis points, are they giving up on that soft landing narrative?
Yeah, and then he, of course, pushed back against that and saying, well, these people are losing their jobs, but what's better for them to be continuing to pay ever higher rates of inflation, right? So it's obviously a dilemma. One other quick note here as we talk about rates going higher for longer and the expectations for a hard or soft landing is that we now have yield curve steeper in inversion, or deeper in inversion, I should say. That means the yield on the 10-year minus the yield on the 2-year as an indicator of recession. We're going to talk more about this later in the show, but it is something that economists and strategists are watching very closely. So now the question is, what do you do with all this information? What do these Fed moves mean for your portfolio? Let's bring in BlackRock America's iShares investment strategy head, Gargi Chaudhry. Gargi, it's great to see you. Thank you so much for being here. As we try to digest what we were hearing from Jay Powell yesterday, and as we see now the terminal rate expectations go to 5.5 to 5.75%, how does that change, if at all, your strategy?
Good morning, Julie and Inez. It is wonderful to be here, and a very happy International Women's Day to you and all your listeners. And in terms of what this means for how we're viewing the world and how we're viewing markets, a couple of things. Just coming into this year, we had held the view that rates would be higher for longer. Now, every single time that the Fed chair speaks, we're learning a little bit more about how much higher it could go, or at least the market is pricing in a higher trajectory. But the story hasn't changed. They haven't been able to conquer inflation yet, and unlikely that they can get back below their or at their 2% level by the end of 2023. And therefore, higher for longer remains the story, which means that we have to be really thoughtful about where in the markets we want to embrace equity markets. And obviously, the valuation in bond markets becomes ever so increasing every single day.
So having said that, where should investors position their money?
Sure. So the first thing is within the bond markets, we think that the very front end looks extremely attractive. When you have bill yields higher than yields at any other part of the curve. So when you're looking at your portfolio, owning something like SHV or owning something like SGOV in iShares stickers make a lot of sense given the yield that they're throwing off. I mean, just about a year and a half ago, we were owning high yield bonds to earn about 5 or a little bit over 5%. So owning the very front end, we think makes a lot of sense in the fixed income markets to earn that income in your portfolio. So really having fixed income do some of the work in earning income, which you weren't really getting till now. But at the same time, as we get between 4 and 4.25 on the 10-year Treasury, and by the way, we just about breached that last week. But as we move higher, above 4.25%, we will also be telling our investors to barbell with their front end something such as longer dated treasuries, such as TLH, such as the ag, because we think that ballast is back in fixed income. So that's how we think about the fixed income markets. And within equity markets, we think a higher for longer environment really supports allocations to the value parts of the equity market. Look, we're still going to have a little bit more of volatility. I think the equity markets will reprice lower. But where you might see outperformance is within the value sector. So really the other IWD, as I like to call it, and VLUE.
Gargi, reading between the lines as well, I'm looking here at the Nasdaq Composite, which is up 10% this year. What you're saying sort of implies, that's not, say goodbye to that growth and big tech trade. Is that an accurate way to read it?
Yeah. So I think, we always confuse growth with tech. Right. I think there are ways to get growth at reasonable prices that are not tech, and can be certain areas of tech as well that are just priced appropriately. I think we are moving away from a regime which is what we got used to for the last decade and a half, where the longest duration of the equity market, the most expensive areas of the equity market did very well because real rates were negative. And now we're hearing from the Fed over and over again that real rates are going to be high. They're going to remain positive. In fact, could even go a little bit more positive from here. So all of those areas in the market that were benefited by lower real rates, by that incredible multiple expansion, that's just not likely to happen. And therefore, you want to go to the areas of the market where you do have some equity risk premium. And if you look at the Russell value versus the Russell growth, you have more equity premium in the value areas of the market. So really thinking through what gives you the best risk-adjusted returns right now.
Great advice. BlackRock America iShares Investment Strategy Head Gargi Chowdhury. Thank you so much for joining us. And the White House is supporting a new bipartisan Senate bill that would give the Biden administration the power to ban TikTok, as well as any other foreign-linked producers of electronics or software that the Commerce Department deems to be a national security risk. And Julie, this is an important development because the White House is throwing its support behind this bill. It's bipartisan. It's called the Restrict Act. And the senators that are sponsoring it are saying, look, this isn't just about TikTok. This is really about this framework for evaluating risk.
Yeah, and this is something we talked to Terry Haynes of Pangea about yesterday as well. And he emphasized that aspect that, yeah, of course, it's going to likely affect TikTok if it does go into place, but that it is meant to be, it's written to be broader. I mean, Senator Mark Warner is somebody who has been he's been active in tech legislation for quite some time, and B, he's been outspoken on this particular issue as well for quite some time. I think it would be interesting to see if it actually comes to fruition. Congress has been debating various caps, limits on domestic big tech for quite some time, and they haven't really gotten anywhere. So it would be intriguing if the thing that ends up happening would be this TikTok ban that then could be broader. I mean, the TikTok is trying to, push back against this to some extent, but I don't know how successful they're going to end up being.
Yeah, and they have proposed what's called the Project Texas. It would involve Oracle to be hosting the data on its cloud, data related to U.S. users. But really, what's interesting also about this bill is that the foreign adversaries are 6 countries, which is China, Russia, Iran, North Korea, Venezuela, and Cuba. So this would also be another sort of elevation when it comes to relations with China. And it's all really all has to do with data in this case.
Yes, data protection.
And control of data.
So that Project Texas that TikTok put in place, where it had the partnership with Oracle, right, under the Trump administration, is when they came out with that and kind of tried to address some of these concerns. They're now doing something similar in Europe, or they're proposing something similar in Europe, where they sort of domicile the data domestically, right, to try and figure out if that will reassure some of the concerns that we are seeing about this. But it's unclear if that will indeed reassure regulators.
And the way that TikTok is positioning this, of course, they're pushing back against this bill, is basically saying that a ban on TikTok is a ban on the export of American culture and values to the billion-plus people who use their services worldwide. So saying also going as far as saying that it's censoring the voices of millions of Americans. I mean, it's their position, of course. They have to push back.
There are other ways. There are a couple other social media platforms, but yeah, we'll see how this all ends up. Adidas is in the hot seat after reporting a $763 million loss in the fourth quarter as it deals with the aftermath of its severed partnership with Ye, formerly known as Kanye West. The athletic apparel brand also cut its dividend as it projects its first annual loss in over 30 years. We're going to do a deeper dive into the future of the company later in the show.
And going from not being able to meet demands in 2021 to an overload of inventories in 2022, retailers are suggesting this year the balance may finally be just right. You can read all about the latest in today's morning brief written by Miles Udland over on Yahoo Finance's homepage. And this is an interesting morning brief because, yes, 2021 was not enough. We have inventory issues. People want more than what we have. 2022 is too much. And now you've got Dick's that said that their inventories was in great shape.
Yeah.
You've got Walmart that ended their quarter with inventory flat. They still have to do some work when it comes to apparel. But you have these retailers that are basically saying, we've got a better situation now when it comes to.
Yeah, and there are a number of different things that are contributing to that, right? On the one hand, you've got obviously supply chain rationalization, some of that normalizing once again. On the other hand, people are not buying as much stuff. So, you don't have shortages necessarily. But then last year, you didn't have as much. So we definitely had some promotional activity for many of the retailers over the holiday season, trying to clear out some of this inventory as well. And now they find themselves in this position, the likes of Dick's and others still seeing increases in sales, which also helps. So I think normalization is sort of the name of the game here, that these various retailers are getting back to. Some interesting stats there from Citi as to what, there it is, as to what we have seen doing the best and the worst, that e-commerce pure play apparel, for example, is one of the areas that has been seeing the least strength, has been seeing the biggest decline. So it really also depends on the subsector of retail that we're talking about here.
Yeah, and definitely the buyers of this inventory they really upped their game after 2021. I think that it was a big shock to the system. I think the supply chain issues was a big shock, and they had to, and the just-in-time scenario sort of came into play. And so there's been a big normalization, as you said, when it comes to inventory levels. Yeah. And while inventory to sales levels are still depressed relative to pre-pandemic, our next guest is keeping tabs on February retail sales set to come out next week, as they are likely to be a key indicator for what the Fed might do later this month. For more, we welcome in Jennifer Lee, BMO Senior Economist and Managing Director. Jennifer, thank you so much for being with us. Happy International Women's Day. And tell us a little bit about your expectations for retail sales. I mean, it is one data point. It is nominal, so it's not adjusted for inflation, but what are you expecting this data point to tell us?
Well, good morning. Happy International Women's Day to you both and to everyone. Thank you for having me on. So next week, it's going to be the second of three key indicators that the Fed is going to be watching for. I thought it was interesting how yesterday he said that there are 3 data points, or actually said 2 or 3 data points that will help guide their decision. Obviously, we know that payrolls on Friday will be one, retail sales and CPI will be the other. So retail sales, we did see that big bounce of about 3% on all the main measures or main components of the survey. Looking for some pullback. Obviously, there is some weather-related bounce from that, which the Fed chair alluded to yesterday. But I think overall, we're going to probably see overall slowing growth. The consumer is, as you were just mentioning, with the inventories data, the consumers have a lot of stuff already, and prices are going higher. So they are starting to slow that spending down, which is, completely understandable, just given how much interest rates have risen.
And Jennifer, it's Julie here. Good to see you. Happy International Women's Day to you as well. So I was just talking about sort of normalization, right? That we've seen this more normalization on the retail side. And some of that is as we have seen spending shift to services, right? Some of it is as people are just buying different stuff or not buying as much stuff. I'm curious, when are we going to see normalization maybe on the services side as well, which presumably would help with the inflation equation?
So that's the big question. And when you're talking about normalization, in my head, I was thinking, I don't even know what normal is these days. It's been all over the place. But, we already saw the pullback in goods because, again, everyone has enough stuff. But there's still that big push for services, for travel, for dining out. That's still going on. But again, we have seen a slowdown overall, and especially in discretionary spending, such as dining out, such as, like recreational services, for example, even clothing, things like that, where you can actually pull back a little bit and not change your lifestyle too much. So we're starting to see some pullback on that. And of course, the higher rates go, the more prices or the more prices are rising, the more expensive it is going to be to, engage in this discretionary spending. So that's where we're going to start seeing some of that pullback. How long that's going to take is anyone's guess right now, but it sounds like it might even come sooner if the Fed does start ratcheting up its interest rate, its Fed funds forecast or Fed funds target a little bit faster than that we had been anticipating, say, like a week ago.
And just off of that, I mean, there have been certain forecasts that have been upped after Jerome Powell spoke yesterday. So tell us a little bit about your takeaways about what you heard. Do you think that there's a case for the Fed to be increasing rates by 50 basis points at its next meeting? And what are you expecting? How are you expecting the economy to react?
Lots of questions. So let me try to. Okay, so first of all, it was a super long testimony yesterday, and luckily, the biggest takeaway I got from it came up right up front in his written testimony when he said that if the totality of the data continued to warrant faster tightening, then they are prepared to increase the pace of rate hikes, and that was the key message. I thought it was also very interesting that he did not dismiss the strong data of late. A lot of analysts did as well, but he didn't dismiss it completely. He said, yes, some of that could have been due to unseasonably warm weather, but he was more taken back, I think, by the breadth of the increase in the revisions of the back data. And as well, again, he's looking for key pieces of data to help guide their decisions in coming months. So is 50 basis points possible? Anything is possible at this point. It's going to fly against what they said before about how that it's time to start moderating the pace of rate hikes. But again, if the data dictate otherwise, they're going to have to shift their focus and possibly put in another 50 basis points.
Whether it's 50 basis points or not, if the terminal point is 5.5 to 5.75%, Jennifer, does that mean we are, have to redo all your calculations for whether we're going into recession?
I think it will. We've been looking for like a few more rate hikes, and again, we're going to make our final decision this Friday after the payroll report. But certainly, the more aggressive the Fed is going to be, either doing a series of 25s or doing more than 25, even doing 50, that will suggest that the economy is going to be coming in for perhaps not much of a mild landing, but more of I'm not going to say hard landing either, but it's going to be more of a bumpier landing than, again, we would have anticipated, say, like half a year ago.
Jen, good to see you this morning. Thanks for being here. BMO senior economist Jennifer Lee. Coming up, WeWork is getting a boost as it looks to restructure its debt. We'll discuss that, plus have the opening bell on Wall Street next. Adidas saw net income slide 83% in 2022 as the company slashed its dividend. Fourth quarter sales were hit by the termination of the Yeezy partnership, and that is really the core of the questions now around what's going on with the company. I mean, you know, Adidas, or Adidas as they like to call it in Europe, still is facing competition from other footwear giants, from the likes of Nike, Reebok, et cetera. But really right now, the main question for the company is, what does it do with all this Yeezy stuff, right? It got rid of its Ye partnership back in October. This stuff has a retail value of $1.3 billion. And the new CEO of the company just kept getting questions. Bjorn Gulden is his name. Just kept getting questions about what are you going to do with this?
What are you going to do with this inventory that you've got, this Adidas stuff? And one of the ideas is selling these products and donating the profit to a charity. There had been talk about whether another option is just getting rid of it, getting rid of the products by burning it. I mean, that's just that would be
incredible that we're even having this discussion.
That's a PR nightmare as well. I mean, you're going to burn products after. I get it that you've severed ties, but it just looks like a big waste. And this is the big risk of also when you go with a personality that then you have problems with issues that you have to sever ties with this personality, then you've made such a big bet and you have invested so much money into this partnership, and then you terminate it, and this is the result. But I think a lot of this also does have to do though with how this will not just it's the bottom line, but also how do you sell this product without a PR nightmare.
Right, because just to back up for 1 second, they terminated this partnership because Kanye West, aka Ye, had made anti-Semitic comments, but obviously even before that, he has a history of erratic behavior, even before they signed the partnership in the first place with him. And so now they are living with the consequences of this. They say there's a 15 to 30% chance they're going to sell all the remaining Yeezy product. But in the meantime, other stuff's going on. Their Asia Pacific sales fell by 31%. They proposed slashing their dividend by 79%. So this is a company where that new CEO I mentioned really has quite a bit of rebuilding to do. Even if you look underneath of that Yeezy partnership, gross margins have been declining for the company. So this is the biggest, most visible thing, but there are some other things to take care of underneath the surface as well.
Yeah, that's right. And they had also warned about this unsold product, Yeezy product, some time ago, back in February as well. So the street was expecting this. But moving on to CrowdStrike. CrowdStrike beat analyst estimates in the top and bottom line as a cybersecurity company. Sees a record fourth quarter with earnings forecast above expectations. And just taking a look at what the stock did in after hours, it was up in after hours, it was up in pre-market right after the company reported its quarterly results. And this is, there were some concerns on the street about cybersecurity market perhaps cooling off a bit because you've got some cash-strapped companies that are trying to cut costs. But this really highlighted the strong performance and also ending the quarter with annual recurring revenue of $222 million, which was highlighted by the company. So the street liking these results.
Yeah, liking these results and highlighting as well, focusing on that recurring revenue that you just spoke about. And it has been interesting how resilient a lot of, not all of, but a lot of the cybersecurity companies have been. We sort of had this debate, right? All of these big enterprise software companies and tech companies broadly, or even beyond tech, right? Any company that needs cybersecurity, how much were they going to cut back? That was sort of the big question going into this. They're cutting back on everything else, seemingly. Is these CEOs of the cybersecurity companies maintained this is going to be the thing they're not going to cut? And it doesn't seem to be universally true. We are seeing some delays in contracts, et cetera. But it does seem to be true in a lot of cases here. And by the way, we're going to talk to George Kurtz, the CEO of CrowdStrike, tomorrow on the show. And we're going to discuss this a little bit further, what worked for him and what's working for cybersecurity.
Yeah, and right now we're going to also go to the opening bell because we are opening on Wall Street.
Yes, we are. And we've got that opening bell on Wall Street here on this Wednesday. KKR, as you can see, all the ladies on the podium for International Women's Day. ringing the opening bell. And our opening bell is sponsored by Tasty Trade as we take a look at the markets here this morning. So after a big drop in stocks yesterday that was prompted by Jay Powell's testimony on Capitol Hill, really emphasizing this idea that the Fed is in it to win it in terms of inflation, that they are going to stay the course and keep raising rates as long as necessary. We are going to be hearing from Jay Powell again at 10 a.m. today in front of the House Financial Services Committee. It was a little spicy yesterday in front of the Senate Banking Committee. Usually it's even spicier when it comes to the House. So we'll see what kinds of questioning and what kind of political grandstanding we get there in the House committee, and then what kind of information, if any more, we get from Powell, or if it's pretty much more of the same as to what we heard yesterday. But Inez, right now, as we get underway here this morning, we're not seeing that negativity that we saw yesterday, but really, we're not seeing much of any movement.
Yeah, that's right. The markets are right now a little bit flat. We had seen yesterday a pretty down day, but right now we're looking at flat markets for the Dow, the Nasdaq, and the S&P 500. The Nasdaq up about 0.2%. I'm going to put up a 2-day chart here so you can see sort of the action over the last 2 days. You can see that a little bit better. But I want to take a look also where we're at with the 10-year Treasury yield, because that's at 3.92%. We talked about the inversion of the 2 and the 10-year yesterday, hitting that 100 basis point mark, and the 2 and the 30-year as well. And just taking a look at the U.S. dollar index, that is at 105.61%. And under the hood, when we take a look at our sectors, so we've got a blank screen here, but you can see that the sectors are mixed right now. Consumer discretionary, financials have been down quite a bit yesterday. You've got technology that's in the green, and real estate recuperating some of the losses from yesterday, up to 0.3%. Over on the Nasdaq 100, a little bit of a mixed picture here with some of the mega caps. Alphabet up more than 1%. You've got Nvidia that's higher. I'm going to take a look at the semiconductors, and those are seeing a little bit of a gain right now. And over on the electric vehicle space, we are seeing some downward pressure in some of these names. And just to round it out with what's happening with commodities, because we had seen yesterday crude oil that was lower, and we are seeing today that it's also, we're watching WTI down more than 1%. Brent crude also lower. We saw the U.S. dollar index rise yesterday, going above 105. It's above 105, around that area right now. So we are seeing a little bit of pressure when it comes to commodities. We also this week had some data, some import-export data out of China as well, which was putting some pressure on commodities as well.
Inez, can I call an audible and ask you to call up oil stocks for a second? Or actually trending. Yeah. How about trending? That's where it'll be. Let's take a look at Occidental, because we learned in a filing that Warren Buffett's Berkshire Hathaway had further raised his stake in the company, 5.8 million additional common shares in that company. So it's been among the top trending tickers here this morning. Sorry to get you.
No, and you're right.
Find it here this morning, but
so Berkshire Hathaway having 21% stake in the company, and now with more than 5 million shares, buying another a little bit more of the company as well. You're looking at Occidental up more than 2.5%. Year-to-date chart, you're looking at it down 0.3%. But this stock was absolutely astronomically saw astronomical gains last year. So it's just above $62 a share. There was a note from Wall Street talking about that this would be positive. The fact that Berkshire Hathaway is increasing the number of shares that it has in Occidental would be positive for the stock. Though the analyst noted he does not think that Berkshire Hathaway is going to outright buy Occidental.
I know, we keep doing that. Will he or won't he? Thanks, Inez, for calling that up for us, because definitely a good one to watch this morning. And there's another good one to watch. That's WeWork. Shares are popping this morning on reports the company is currently in talks to raise millions in capital and restructure its outstanding debt. The shares are up 4% here this morning. WeWork, as you might recall, of course, the infamous office share company that had been founded by Adam Neumann, who is no longer with the company. But according to Bloomberg, Yardi Systems, which is a real estate software maker, is weighing an investment in the company, and that it is trying to raise some cash here. WeWork, by the way, is down 20% year to date, down 77% over the past year. So it has not participated in the bounce that we have seen in some stocks this year. It has just kept going down.
Yeah, and you have to also wonder about the market. I mean, you're looking at commercial real estate that is really difficult right now, and it's supposed to get more difficult. This thing about working in the office, working hybrid, working from home, I mean, is this a permanent change that is happening with this hybrid work, where you go into the office just a couple of days a week, where some companies have said, okay, you can work remote. Others are saying, oh, come in 4 days, 5 days a week. But those that are coming in just a couple of days a week, you have to wonder what this is going to do to the commercial real estate market, to the office spaces.
Most definitely. And over at WeWork, I mean, I was just looking back at their last results as we consider this attempt to raise cash or to get an infusion of capital. And the company's still posting EBITDA losses, right? So free cash negative, basically. That's what it said for its fourth quarter. Its revenue forecast for its first quarter was below what analysts had been anticipating. So yes, it's getting a little bit of infusion. I mean, look at it. It's $1.16. It's just incredible, the round trip for those of us who covered this company as it was, you know, being touted in the private markets and then coming public and everything.
It was supposed to be a huge, massive IPO. The pandemic.
It was going to be everything. The We Company. They were going to do it all, right? Well, so much for that.
Coming up, Citadel's Ken Griffin is doubling down on AI. We'll discuss his plans for ChatGPT next. Stay with us. Citadel is doubling down on AI. Founder Ken Griffin says the company is in talks to instate an enterprise-wide license for OpenAI's artificial intelligence application, ChatGPT. Yahoo Finance's Dan Howley has the details. So Dan, what does this entail?
Yeah, this would go basically across everything that Citadel has. They're looking at, potentially using this to help put together, everything from maybe portfolios to presentations. That's what ChatGPT has the power to do. And it's interesting because we've seen so much kind of backlash from ChatGPT. I think when people first started looking at it, they kind of considered it, that this was going to be something like a be-all, end-all for artificial intelligence. And the reality is it's not. It's still something that's being tested. OpenAI is, basically telling people that Microsoft with its Bing, which is based on an enhanced version of ChatGPT, also telling people that. So, this is something that we're going to continue to see moving forward. But with Citadel, it's interesting just because it's such a powerful company, obviously, when it comes to Wall Street. And, we've seen pushback from other Wall Street firms saying, look, we don't want to use ChatGPT at this point. We're not sure that it's the right move at this time, maybe in the future. But at this point, it's just not ready for prime time. Citadel, meanwhile, Ken Griffin going, well, we'll dive headfirst and see where it takes us.
Yeah. Are we tired of talking about ChatGPT yet until the next thing? No, we're not. We're going to be talking about it much more, Dan. Sorry. It is interesting that you bring this up, that the other Wall Street banks have been a little more cautious, because when I saw this story, I thought, it's interesting because I have mostly been thinking about ChatGPT in the context of the tech world. And here we are talking about it in finance, which led me to think about what other kinds of applications in other industries. And I know it's super early, right? But surely this is something that a lot of companies that are not directly in the tech industry are thinking about right now.
Yeah, look, this thing can help put together code. It can help you put together small presentations, as I said, letters, basic documents, things like that. So there are ways that this would be able to help do away with some mundane tasks and automate them to a degree, right? Now, what that means for employees, whether or not it'll actually take off in that direction, that all remains to be seen, but it does have that potential. And I think, if it's given time to grow, it could be a really impressive and important app. The important thing, I think, to point out, though, is this is still very early innings, as you were saying. And also, it's not what's considered general artificial intelligence. That's what people think, like Skynet or something like that, or, a robot that's self-aware or something along those lines. This is predictive text to like the nth degree. So, the way it's kind of been discussed to me is, when you type into your smartphone keyboard, when it gives you suggestions for the next word, and if you just keep tapping, it'll keep providing you a new sentence. So that's essentially what this is to a greater degree. It's not exactly going to be the end-all, be-all, though. So you have to see where it goes at this point.
Yeah, we're not at the point where I can just look at my phone and it'll know what I want to text before I even. No, we're not there. Okay, thanks, Dan.
Constantly saying duck. I never mean to type duck.
Yes, why hasn't it figured it out yet? All right, thanks so much, Dan. Appreciate it. Coming up, what to expect from Biden's 2024 federal budget proposal. We're going to speak with Maya McGinnis for her take. That's next. The White House is set to release President Biden's budget proposal for 2024. The stakes are higher than ever, with the national debt approaching record levels. It depends on which economist you talk to, how concerned they are about that one. But interest payments are also set to triple over the next decade to become the single largest line item in the federal budget by 2050. This, according to the Committee for Responsible Federal Budget. And the president of that organization, Maya McGinnis, is joining us now to discuss. Maya, it's great to see you. Thank you for being here and always being so gracious to talk to us about these budgets, which are a thorny issue to dive into. What we know about the budget, from what we know about the budget thus far, what stands out to you if you had to sort of put things in the negative and positive column?
Well, I think we have a pretty good sense of what we're going to see in this budget. The president has already floated his plan to help lengthen the solvency period for Medicare. And that plan is raising more revenues and putting additional revenues into the Medicare trust funds. And I think that's kind of illustrative of what we're going to see throughout the budget, which is we know the president is going to push for a lot of new revenues. This was what was in his budget last time. They've already raised some taxes, but a lot of taxes they've looked at, for instance, increases in corporate income taxes, haven't happened. And I'm quite certain that the big push in this budget will be new revenues. It will cover additional spending, and there will also be deficit reduction. So from a fiscal perspective, it's a step in the right direction, assuming they do reduce the deficit. That is the right thing. But I think the devil will be in the details, and I can tell you, as is the case with most presidential budgets, this will go nowhere. This will not be the beginning of earnest negotiations, which is what we really need.
Go nowhere? Oh, no. Tell us a little bit about how does inflation play into all of this? Because inflation is really front and center this year. Talk to us about the challenges when it comes to inflation and this budget.
Excellent question. Obviously, dealing with inflation is one of the most important economic priorities that there is right now. It falls mainly to the Fed to handle this, but not entirely. And what we've seen for the past years is that fiscal policy, which has been expansionary even once the economy was strong, has made inflation much worse rather than better. And so one of the things normally when the fiscal situation is bad as it is right now, one looks for how is the debt to GDP going to look over a 10-year budget, 10-year window in the budget that the president submits. It's going to be different this year. We're going to be looking very closely at what happens in those first 2 years. A lot of times what you see with politicians is they plan to borrow even more in the short term and promise to save a lot later. No surprise that savings doesn't happen as often as one would hope it might. But in this case, it's really going to be important that we see those savings immediately next year and the following year when inflation are still supposed to be strong. And just as a reminder, what we're already seeing because of rising interest rates, huge interest payments. We are on track, if we don't borrow anything new in the next 10 years, to spend $10.5 trillion on interest payments. Within 5 years, we'll be spending more on interest than we do on defense. So that's a real warning sign that because we have so much debt, when you see high inflation and then subsequent high interest rates, it really costs the overall budget a tremendous amount.
So obviously, making it clear why this is an acute need to address right now. Maya, you mentioned it's not going to get done, right? And just to be clear to our viewers, right, when a president comes out with a budget, it's effectively a wish list, right? It's a list of things that the president would like to do, but the president can't come out and just raise taxes without any, he needs Congress to be on board for at least some of the stuff that is within the budget. What's the most likely to get done, especially considering the Congress that we have right now, or what can the president just do on his own?
So what the president has really here to use is the bully pulpit, meaning once he puts his budget forward, is he going to continue to push some of those ideas, many of which will be popular, at least with his party. There's a lot of divide between the parties and what's popular these days. But is he going to push his priorities, or is he just going to put his budget out there and let it lie? And if he's serious about it, he'll push it. But honestly, it is going to be such a kind of bookend of what Democrats might want and be contrasted with what we're going to see out of the Republicans when the House Budget Committee does their budget. I think this is just going to be, here are the two ends of what people might want. One is going to be all taxes. The other is going to be all spending cuts. Neither of them is realistic. And frankly, neither of them is the right policy. We need compromises on both. So what one hopes is This will be the beginning of the budget season, the budget process. It's a month late, but next what we expect to see is the House and Senate budget committees submitting their own budgets. It will be really important that each of those committees put forth budgets. Frankly, last year, neither of them got budgets out of committee, and you kind of wonder, like, what is the budget committee doing if they're not putting forth a budget? There's a rumor the Senate might not try to do a budget, and I desperately hope that's not true. It will be a huge abdication of responsibility at this moment when the fiscal situation is so bad. But once we see the budgets out of those two committees, they will attempt to reconcile them. Again, I don't think they'll succeed. But the reason it's so important that we go through this process right now is the other option is we talk about these issues as part of the debt ceiling. And that is a much more risky strategy with many, many dangerous potential outcomes when people are talking about not lifting the debt ceiling unless we get some savings done. We do need budgetary savings. We need it because the debt is high, and we need it because inflation is high. But the best thing would be is if we could negotiate those through the normal budget process. The president will have started it. It's really going to fall into the budget committees to see whether they can wrestle through these numbers and come up with some actual savings. Get that done well in advance of the need to lift the debt ceiling, which we should do without drama.
Well, hopefully that will happen. But given past history, not sure how likely, unfortunately, that is to be the case. Maya, great to catch up with you. Thanks for your time this morning. Maya McGinnis, president of the Committee for a Responsible Federal Budget. Coming up, the yield curve's inversion reaches a new milestone. What does that actually mean for your investments? We'll break it down next. Yesterday's testimony by Fed Chair Jerome Powell pushed the U.S. Treasury yield curve to its deepest inversion since 1981. And we're going to talk more about what all of that means. So basically, as you pointed out earlier, the 10-year yield is just under 4%. Of course, earlier this year, it already has touched 4%. And when we talked about inversion, we're basically talking about the gap between the different Treasury notes, right? So in this case, usually when people are talking about this, Inez, they're talking about the 2-year yield and the 10-year yield, right? And they're talking about one minus the other. When the 2-year yield is higher than the 10-year, as it is right now, you see this go into inversion.
That's right. And this is where investors expect that in the shorter term, there's going to be higher rates, but then they're expecting that the higher borrowing rates will hurt the economy. So therefore, rates will have to come down later.
Yes,
so that's sort of the behind the what's going on with the inversion there and what it signals about what could happen with the economy.
Well, let's talk about that in our next chart here, because what's interesting is there's concern that this signals a recession. If you look historically, almost every single time yield curve has gone into inversion, we've had a recession. So here, let me explain this chart. This is the same chart we were looking at before, the gap between the 10-year and the 2-year. The white line here is 0. So every time this purple line has gone below the white line, we've seen the yield curve inverted. What's the red? The red are recessions. So we have inversion, recession, inversion, recession, inversion, recession. You get the idea. That is why we are seeing so many economists and investors concerned about this right now.
And Deutsche Bank's Jim Reed actually put out a note talking about the 2 and the 10-year inversion and that 100 basis points spread there. That would mean that he's saying that that inverted data, since the data is available since the 1940s, that a recession has either been underway or has occurred within a maximum of 8 months when the 2 and the 10-year is inverted by at least 100 basis points.
Yeah, this one goes back to the 70s, so it gives you an idea of what we have seen. Why don't I go back for a second and we'll take a heat map of the banks, because we have a lot of different groups here that are affected particularly acutely when we are taking a look at the action here in the inverted yield curve. And the banks really fell yesterday. Here's a 2-day look at the banks, just to give you an idea of what we have seen.
So the interesting thing about the banks is that, you know, up until now, really, or for a long time, banks have basically said, well, if you want to put your money with us, you can put your money with us, but we're not really going to give you anything. But as the rates go up, then the banks are sort of competing for deposits, for money to be at their bank. So then they have to increase their rates. And what that does is that hurts their profits. So the rates that they give you back, right, for holding their money in the bank.
Exactly.
So that's why you saw, especially the regional banks, seeing some big pressure.
Yeah, like a PNC, for example, is one of the regional banks. Effectively, what investors watch from these banks is what's called the net interest margin. That's the difference between what Ines is talking about, what they pay you on the money you deposit with them, and also what they make on the loans that they make out. If I loan you money as a bank, I collect interest. So what's the difference between the interest I pay out and the interest I take in? That's the net interest margin. So there's concern that that's going to be going down.
And so we saw yesterday the banks down. Today we're seeing the banks a little bit under pressure as well, too. Yeah. Coming up, we'll get those day 2 headlines from Fed Chair Powell's testimony in just a few minutes. Plus, we've got a conversation with the CEO of Weight Watchers. You won't want to miss that. Stay with us.
Welcome back to Yahoo Finance. I'm Julie Hyman with Inez Ferre, and we've got some breaking economic data out this morning. U.S. job openings from the month of January, also known as JOLTS, coming in at 10.8 million. That means there are still 10.8 million open jobs in this country, according to this report. It is a drop from December, but it's still higher than estimated. And guess what? The December number was revised higher. It was revised up to 11.2 million. So going from 11.2 million job openings to 10.8 million job openings, I mean, it's less, but it's not that much less. And it's higher than the 10.5 million that economists were looking for. Still, I mean, it's just astonishing. On top of, we should mention the ADP employment number this morning for February that came in above estimates, adding 242,000 jobs. I guess what I'm saying is, bottom line, this job market has still managed to be incredibly resilient.
And you can see the market reaction right now, because we're looking right now at session lows for the Dow, the Nasdaq, and the S&P 500. So certainly the market's anticipating that the Fed has more work to do because of stronger job data points that we're looking at. The Dow's down 0.3%, the Nasdaq down about the same amount, and the S&P 500 also lower 0.2%. Really significant little drop there that you saw as these JOLT report numbers came out.
Yeah, we saw the number of quits. The quit rate is something that a lot of economists have been watching closely. How able do people feel? How do they feel they're able to quit in this environment? Can they find another job easily? The rate there was little changed at 2.5%. The number of quits was down by 207,000 because the absolute number is so big. The rate did not change by that much here. Quits decreasing in professional and business services, educational services, and in federal government. The number of layoffs and discharges did go up by 241,000, but again, the rate was a little changed. So, yes, we keep talking about, anecdotally, big tech companies cutting back on workers. But if you look at the overall job force in the U.S., it has not moved the needle yet by that much.
Yeah, and those tech jobs are only a percentage, really, of the workforce here in the U.S. And the employment situation, jobs, that is something that Fed Chair Jerome Powell has been speaking about. And he continues his testimony before Congress today after sending markets lower yesterday following his hawkish remarks to the Senate Banking Committee on inflation and interest rates. Here with what we can expect from today's testimony from Powell is Yahoo Finance's Jennifer Schomburger. Jennifer, take it away.
Good morning to you, Inez. That's right. Fed Chair Powell back on Capitol Hill this morning for his second day of semi-annual testimony to Congress, this time before the House Financial Services Committee. This will be the first time that Powell is testifying before this House committee since Republicans have taken over the House since the midterm elections. Powell will reiterate in nearly identical remarks he told the Senate Banking Committee Tuesday that inflation is running higher than expected and that interest rates will likely need to be raised higher than previously thought. Powell opened the door to raising rates by a larger 0.5 percentage point later this month after slowing down to 0.25 point last meeting as the latest inflation and jobs data have come in stronger than expected. Powell also laying the groundwork to offer the optionality to move faster, given that we're going to get a fresh jobs report on Friday, followed by the Consumer Price Index next week. And should those clock in strong, that could open the door for a faster pace. Powell said in testimony, if the data were to indicate that a faster tightening is warranted, we would be prepared to increase the pace of rate hikes. Take a listen.
The data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
In December, Fed officials anticipated raising the benchmark policy rate this year to between 5 and 5.5% and hold it there into next year, though Powell, of course, now suggesting it will need to be raised higher than that, and policymakers will pencil in just how much higher at their meeting on March 21st and 22nd. Today is Powell's final opportunity to shape the conversation, his last remarks ahead of the Fed's usual 10-day blackout period before their policy meeting. This hearing getting underway just right now. I will have the headlines for you as I get them. Back to you.
Indeed you will, Jen. And just a quick mention on International Women's Day. Happy International Women's Day, by the way. As far as I know, you're the only
Thank
woman.
you. Happy International Women's Day to you.
Thank you. You're the only woman in broadcast, as far as I know, covering the Fed down there in DC for us. So thank you very much for the work that you do. Got to turn now to Weight Watchers. Those shares are settling down after skyrocketing 79% by the end of yesterday's trading session. That's after announcing plans to acquire Sequence, which is a digital health platform for clinical weight management. Here to discuss what this means for the future of weight loss innovation and more is Weight Watchers CEO Seema Sistani, along with Yahoo Finance's Anjali Kemlani. Seema, thank you so much for being here. Obviously, a huge gain in the stock that we saw yesterday. Weight Watchers has sort of been trying to figure out its identity now for a number of years. What does this mean for the future of the platform as a whole? How should people be thinking about Weight Watchers at this point?
Well, thanks for having me, and happy International Women's Day to both of you as well. Look, we're, first of all, managing to the long-term health of the company, not the stock price, though obviously the market validation was nice to see yesterday. I joined as CEO last year, and I really believe that this is a product, a science-backed solution to weight loss management, full stop. And no matter what that pathway is, whether it's through lifestyle and behavior change, which is what we have done for 60 years, or whether it's introducing new pathways through, clinical interventions, as we announced to the market. The other thing I'd like to know as we talk about finding our identity is I joined last year, but I actually joined Weight Watchers in 2014. This is a program that worked for me, helped me lose my weight after being postpartum, struggling with a thyroid condition. It is a program that is proven, that works, that is science-backed. And that's why I think it's really important that we enter the space and we continue to advance along with the science.
Seema, Anjali here. I hear you, and I know that you've been questioned a lot about this, especially because Weight Watchers, the reputation has been over the years, not a clinical, not a prescription sort of program. And so looking at it now, do you see maybe a split in who your consumer or who your members will be and who qualifies, let's say, for using that clinical intervention versus those who won't?
So what I would say underpins all of our solutions is evidence-based programs. So our behavior change and lifestyle program is backed by 35 clinical trials, over 140 peer-reviewed studies, and what we've seen now is this innovation that is understanding, that is recognizing the biological components that underpin a complex condition around living with overweight and obesity. And to that end, these drugs, these medications, they're not for everyone. I think that there's been a lot of misinformation and misuse, treating them like something where you're going to lose 10 to 20 pounds for your reunion. That's not the appropriate use for these medications. They are meant to be chronic weight management for complex disease. And I think that to your point, right now, the FDA recommends that if you have a BMI of over 30 or a BMI over 27 alongside, another comorbidity, that these pathways may be right for you. And if medically appropriate, we want to be able to provide the full stack solution for our members. But the important thing to note here is what these medications do is help you with your adherence to a lifestyle and behavior therapy. So the Weight Watchers you know and love is not going anywhere. It's an and, not an or.
And just to put some of those numbers in perspective of what you're talking about when you talk about BMI, I believe the CDC says that BMI for women, a healthy weight BMI should be 18.5 to 24.9. Seema, reading between the lines here, there's been this wave of influencers and celebrities who've been using these drugs. Many of them do not have the BMI that you were describing. It sounds like you think they're doing people a disservice maybe by publicizing use of these kinds of drugs.
Well, I think that this is why we need to lead from a point of responsibility and science to really help people understand and educate them about the science. And I think that's where we have a lot of value to add, is to take the consumer approach, the evidence-based consumer approach, so that they understand what their options are. And to your point, I think part of that is recognizing that these aren't quote unquote weight loss drugs. These are chronic weight management prescription that can help you with the conditions of living with overweight and obesity.
I think what you're saying is, we're starting to recognize what has been happening in the medical space, which is obesity and being overweight. That's something that is starting to be looked at more from a medical lens than just a lifestyle lens. And we've seen that with food insecurity, food access, healthy food access, and the like in the healthcare space. So it's interesting that you're looking at that. Now, just one more question on that, specifically on the prescriptions. How are you integrating that when it comes to the cost of it? Who's bearing that cost if you do end up prescribing it? Is it part of that membership fee, or is it an additional cost for whoever gets prescribed?
Yes. And I do want to recognize what you said around obesogens that have become prevalent in our society. So, willpower alone in a lot of cases has become is complex, and because of the genetic and the biological, environmental, socioeconomic obesogens, that's where these medications can help with adherence. And to your point, Sequence, the platform that we acquired, it is providing access to a provider. It is a simple UX. Imagine, being in a chat with a whole care team, clinician, nutrition expert, fitness expert, who can address a lot of the complications that come up with being on, chronic medications. And this is not like an ED script that you can just get and walk away. It requires a lot of care management. You have to titrate your dosage. And so what we're offering is the platform to enable to do that. And alongside that, putting the insurance process on tech rails such that it becomes easier to access these medications if you medically qualify and have them covered. So the Sequence subscription is the care management, and ultimately we're in the subscription business, not the prescription business. That is still something that though we'll manage the insurance side of things, will ultimately be a cost that the consumer takes on. We try to help with the insurance side of things, because again, if you're medically qualified, in most cases, insurance, depending on the employer, will cover.
So it sounds like there's, at least some guardrails to make sure that you're not overprescribing and that you don't contribute to like a shortage of the drug.
Absolutely, we don't want to get in the way of the patient, the patient provider experience. That is between them.
So let's talk about this, what is being branded as or being perceived as a pivot. Prior to you coming on, Weight Watchers was pivoting already away from just a diet and branding perspective into wellness. And it seems like a lot of that effort into wellness has either been scaled back or is shifting back into, Weight Watchers' traditional or legacy, if you will. So can you kind of clarify, like, what is this new look forward? What's the outlook here?
Yes. So yes, I would say that when I joined last year, I thought it was important for us to embrace our heritage around being Weight Watchers and being prideful in that legacy, and take on our responsibility of entering into the conversation around weight loss and what it can do for people's health. I mean, we are underpinning our food science and our lifestyle behavior change therapies is community ultimately. And that's why I was so excited to come here, coming from, a background of growth tech and social. This is truly the OG social network. This is how people connect around a vulnerable, experience. Weight loss is very emotional and requires an emotional solution. And so I think this is to be clear, it's not a pivot. We have re-embraced our core expertise of being the leading provider of weight loss solutions, and the ecosystem has expanded, and so too will we. I mean, the example I keep giving is like Amazon was a bookseller. They're still a bookseller, but they just do a lot more. I think we are a trusted brand. We have a lot of value to bring to this space, underpinned by our nutrition science, our behavior change program, and most importantly, our community.
Seema, thank you so much for being here. Seema Sistani is Weight Watchers CEO, as well as our Anjali Khemlani for joining. Appreciate it to both of you. Now we got a trending ticker watch for you. Stitch Fix. Those shares are plunging after the online subscription clothing company reported a much wider loss than estimated, as the number of active clients fell 11% and revenue per active client missed forecasts. Net revenue overall fell 20%. That's a drop that Ed Yaruma of Piper Sandler said points to, quote, foundational issues. The revenue forecast for this quarter also trailed estimates. And on top of all that, Chief Financial Officer Dan Jetta stepped down. Turns out he's joining Roku as CEO. And this all came after Stitch Fix's CEO stepped down in January. She was replaced on an interim basis with founder Katrina Lake. At the time, Stitch Fix also cut about 20% of its salaried staff. Coming up, media giants are laying groundwork to improve their ad markets. Ali Canal is going to break down the moves that companies are making next. Plus, how taxes are changing for gig workers, we'll discuss later on in the show. Let's do a quick check of the markets sponsored by Tasty Trade. We see all three major averages in the red, but not by very much. Now, just to refresh your memory here, we saw that big plunge yesterday after Fed Chair Jay Powell spoke in front of the Senate Banking Committee and committed the Fed to continue to raise rates in order to combat inflation. Today, right now, in fact, he's speaking in front of the House Financial Services Committee. So far, I should say, not many headlines because he's delivering the same prepared testimony that he delivered yesterday. Then he will undergo questioning by members of Congress. But we're seeing stocks fade a little bit as he is talking here. It looks like consumer discretionary is the worst performing group on the day. Real estate and materials have been gaining some steam. And of course, we continue to watch the action in the bond market as well. Well, as earnings season winds down, media giants have weighed in on the current state of the ad market, with some pointing to stabilization. Others say it's still up and down. Yahoo Finance's Alexandra Canal joins us now with more. Ali, which is it? What's going on?
The moral of the story is here, we don't know. Yeah. But this has been top of mind for investors because this shaky ad market, it has impacted results both in the fourth quarter and really all of 2022. So I listened in on all of these recent earnings calls, and here are some of the top takeaways from these media executives. Number one, most media execs believe we will see the ad market improve in the back half of 2023, and that things will still be up and down in the first half, similar to what we saw in Q4. That being said, a lack of cyclical events such as the World Cup, in addition to the Olympics and U.S. midterm elections, that will all likely be a drag on ad spend this year. So something to keep in mind as we monitor the progress of this recovery. Areas of strength in the market so far include sports, pharma, travel, and most recently autos, as the chip market has seen more improvements there. But overall, the macro still remains uncertain, and none of these executives could really give a firm prediction of the future here. But if we take a look back to 2022, recent data from media investment and intelligence company Magna Global estimated the domestic ad market totaled $318 billion, an increase of 8% compared to 2021, largely due to those cyclical events. For 2023, Magna estimates U.S. ad spend will grow by 3.7%, lower than its September forecast of 4.8%, as the economy is expected to remain pressured early in 2023 before picking up as inflation cools. So, like I said, still to be determined this year. I think in 2024, we're going to have a bit more clarity when it comes to where the ad market stands as those macro conditions improved. But for now, it is encouraging to see at least some optimism from these companies when it comes to the back half of the year.
So given the ad market and where we're at there, what does this mean for companies like Disney, like Netflix, which started offering its ad-based, ad-supported subscriptions?
Yeah, and that was a really interesting time for these companies to debut their ad-supported tiers, right? We had all these macro concerns. However, a lot of these streaming giants were hemorrhaging money, and they needed ways to supplement their revenue outside of those premium subscription tiers. Advertising is one great way to do that. And from the updates that we've been given so far, it seems like it's working out. We haven't had a lot of details, a lot of specifics at this point, considering both Netflix and Disney rolled out their ad-supported tiers at the end of last year, Netflix in November, Disney in December. But at the time of Disney's debut, the company said over 100 advertisers bought inventory for the launch. Similarly, Netflix revealed it nearly sold out of all of its own ad inventory globally for their respective launch. So multiple signs that ad buyers, they're still willing to spend money where consumers are. And right now, that is on streaming platforms. So I'm sure over the next 6 months to a year, we're going to get even more updates on how those ad-supported tiers are doing.
I will confess that I signed up for Netflix to watch that Jonas Hill documentary.
You didn't?
I did not like it.
Wait,
with the ads. With the ads.
Oh, with the ads.
With the ads. I didn't like it. I did not like it because if you try to avoid the ads by going somewhere else on your browser, it stops the ad and then you gotta listen to it.
Okay.
Yeah, I haven't watched a commercial. I guess I watched the commercials during the Super Bowl. That's the only time I watch commercials. The rest of the time,
even then, I feel distracted during that.
It's worth it without the ads. I think it's worth it. Coming up, thank you, Ali. Crypto-friendly bank Silvergate is fighting to keep its head above water. We'll discuss the company's latest talks with the FDIC next. The digital crypto-friendly bank Silvergate is now in talks with the Federal Deposit Insurance Corporation to salvage its business. FDIC examiners are now at the bank's offices, a sign of the urgency around the bank's lending woes. Yahoo Finance's David Hollerith has the details. David.
Inez, because the FDIC is regulated by the Federal Reserve, the San Francisco Federal Reserve is likely to decide what's best for Silvergate at this point. Now, even with the Federal Reserve and FDIC involvement, Silvergate could still stave off failure. And in that scenario, it sounds like it would be something like crypto investors or other firms offering more liquidity. If Silvergate can't find a solution, banking regulators will put the California bank into receivership. This is kind of like bankruptcy. In that scenario, the FDIC may also try to sell its business to a healthy firm. And in parallel, Silvergate's holding company could also file for bankruptcy. It owns the technology assets of Meta's sunsetted Diem stablecoin. It also has a payments network built for crypto exchanges that's quite valuable, at least to that industry. And if Silvergate does go into receivership, it will be the largest bank receivership we've seen since 2010 in the U.S., as Silvergate has at least $10 billion in assets. It also has $4 billion in loans from the Federal Home Loan Bank of San Francisco, but those loans are fully collateralized from what we know. So how this all happened, effectively, the bank's balance sheet grew too much by catering to crypto clients. It started serving crypto customers, or mostly exchanges and other firms, as early as 2014. Now, when FTX collapsed back in Q4 of last year, its total deposits, which had previously been stable, fell 52% from $13 billion in Q3 to $6 billion. And it also reported $1 billion, or nearly $1 billion in losses. So from that perspective, in the best of times, the company's net income averaged about $500,000. So this was $500,000 per year. So this was a huge loss for the quarter. And getting those deposits pulled so quickly also meant they needed more cash, more liquidity, and reported further losses last week, which obviously caused a number of firms, including crypto companies, to yank more deposits, which has only hastened that problem. So for crypto firms, I think what we can tell is until there's any wrongdoing made, which at this point no wrongdoing has been brought to our attention by regulators, is that if banks want to serve crypto firms, they have to be sure to keep it as a lower portion of their total balance sheet or total deposits.
David Hollerith, Yahoo Finance's David Hollerith, thanks so much for joining us. And Grayscale Investments seemed to gain headway in its case against the Securities and Exchange Commission in its most recent court appearance, as it looks to convert its Bitcoin trust ticker GBTC into an exchange-traded fund. But why should investors care if they're getting shares in a trust versus a spot Bitcoin ETF? Santa Clara University Levy School of Business So-Young Kim joins us now. So-Young, thanks so much for joining us. Talk to us a little bit first about this difference between shares in a trust and spot Bitcoin ETF.
Right. Well, thanks so much for having me, Ines. Now, with the way that ETFs work, there's a redemption feature where you have these authorized parties that are going to serve as a market-making mechanism, where if the shares of your ETF depart too much in value from what those underlying assets are worth, you'll have these authorized participants that step in. Now, what's happening here with the trust is that this trust is actually holding Bitcoin on its balance sheet, but now the investors who hold shares of this trust are not able to actually redeem their shares for either the like-kind money or the Bitcoin itself. Now, where that might become an issue is if investors start to have, if their faith is shaken in terms of whether or not a trust is going to be an appropriate custodian. So we've seen now numerous cases of custodians that were improper custodians. We've seen FTX, we saw Quadriga, we've seen Bernie Madoff. So it's not just a crypto problem. But if investors are worried when they can't redeem their shares and they're concerned as to whether or not you have the assets that you claim to have, that could be one reason that the value of your shares will depart from what the underlying assets that you supposedly hold are worth. Now, there are other reasons that investors may become scared, which is that during this time of illiquidity, they might become very worried with the volatility of Bitcoin. And so while so many other things in the crypto market are happening, if you're not sure when you'll be able to cash out, you might be willing to cash out at 50, 60% of the price that you think the market value of something is. And that's another thing that's happening with some of the investors where they've decided they'd rather cash out at a 40% discount. And that's where part of the departure of the value of the share of an investor's share in the Grayscale Bitcoin trust, why that's departing so much from what the underlying Bitcoin should actually be worth.
Right. Well, and it's also departed because Grayscale, right, so young has not been able to make progress in actually getting the trust converted to an ETF, which would, in theory, increase liquidity of the instrument, accessibility of the instrument, would also solve this redemption issue that you're talking about. The companies faced some lawsuits related to all of that. It seems like the conclusion of the hearing yesterday was a step in the positive direction for Grayscale. So just to sort of put it all together for us, what would it mean if it does succeed in its quest to convert this to an ETF?
So there would be a couple of things here. One is that if Grayscale indeed doesn't have the Bitcoin, then all of this will fall apart, and simply becoming an ETF won't help the price of its shares converge to what that net asset value should be. Now, the way that Grayscale is fighting for this, it seems that the belief is as long as they can get investors to truly trust that they have those assets that they have taken custody of, that they can actually trust that the trust is holding what it's supposed to be holding. Now, if an authorized participant comes on board to serve as that authorized participant who is going to redeem and also create shares on behalf of this ETF, then that'll give investors more faith that the authorized participant itself has taken a look at what Grayscale is actually doing. Because these authorized participants are going to be very large financial institutions. So we're talking about the Goldmans or the Barclays of the financial institution space that step in to serve as an authorized participant here. So that's one thing. The other thing is, of course, a lot of other players are going to step in, because the question here that Grayscale is litigating is whether or not this Bitcoin ETF is going to meet the exchange standards for listing and the SEC's criteria as to whether or not the focal point here, where the focal point has been, is there a regulated market of significant size? And the SEC decided that the Bitcoin futures market is a regulated market of significant size. And what's strange about that argument is that the Bitcoin futures market itself is predicated ultimately on a reference price that comes from the underlying spot market for Bitcoin. And so to piggyback off of the Bitcoin futures market by dint of being run by the CME, to say that that is a regulated market of significant size when you won't allow the spot market to be one of significant size is a little strange. And that's the argument that I think Grayscale has been making. And it seems like that's gaining a lot more traction than it did 5 or 6 years ago, when the first arguments for putting together a Bitcoin ETF were shot down.
Yeah, and that's what you're talking about is very similar to, it seems, just the line of questioning from some of the judges, the judge yesterday, I should say, in this case, which is quite interesting. So ultimately, and you've sort of talked about this, but just to put a fine point on it, if I'm an investor in this instrument, why do I want it to be an ETF versus it being a trust? And again, I know you've talked about it, but just to kind of tease out the specifics.
Right. So with it being a trust, now there are several ways that you can set up these types of investment companies. One, the most that people are familiar with is the mutual fund concept, where with a mutual fund, you can never have a departure from NAV. A mutual fund is highly regulated, and anytime a single investor wants to redeem their shares, they get to do it at what we call the NAV, which is the net asset value. So the mutual fund is holding on to a lot of different types of securities, and whatever is the pegged closing price, whatever is the total basket of what those securities should be worth at the end of that trading day is what I would be able to redeem my mutual fund share for. Now, if we depart from that and go into more of a closed-end fund structure, that's the way that Bitcoin, that's the way that the Grayscale Bitcoin Trust has currently been operating, which is very close to a closed-end fund where they have a trust that's actually holding on to this Bitcoin. And now they've issued shares, and each share represents a fraction of a Bitcoin. Now, where the departure from that model versus the ETF comes in is that Grayscale is not required to redeem shares. So I may hold shares of the Grayscale Bitcoin Trust, and if I want to cash out, the only way for me to do that is for me to sell my shares on the secondary market. But I can't go to Grayscale and redeem those shares myself, either for the cash equivalent or for the Bitcoin itself. Now, the move to an ETF is a bit of a hybrid where you have a large financial institution that's stepping in to serve as this function to allow investors to redeem their shares by way of this authorized participant. So what the authorized participant would do is if Bitcoin is trading at a higher value than what the shares of the ETF are trading at, then this authorized participant will want to create more shares of the ETF. They'll go out and buy Bitcoin, deposit it in the trust, create more shares of the ETF and sell those shares. So you'll start to see the value of those shares converge to what that Bitcoin is worth. And now at the same time, if those shares start to become worth less than what Bitcoin is worth, then the authorized participant will do the opposite. They'll go out and they'll purchase shares from investors, and then they'll redeposit those shares because only this authorized participant has the institutional size to collect enough shares. And now the trust will be required to redeem that large quantity of shares that the authorized participant is coming up with. And the trust will, in that point, as an ETF, be required to redeem. So now that authorized participant will get the Bitcoin and will be able to sell the Bitcoin in the open market. So that's the mechanism here that would be keeping the prices closer in line. That's not happening right now with a closed-end fund-like structure that Grayscale is operating at.
Thank you so much, So-Young, for breaking all of this down for us. Santa Clara University Levy School of Business's So-Young Kim on Bitcoin ETF products and specifically Grayscale. Thank you so much. Appreciate it. And for more on Grayscale's ETF efforts, tune in tomorrow. We're going to talk to Grayscale CEO Michael Sonnenschein in the wake of that hearing. I should also mention, by the way, as Fed Chair Jay Powell speaks in Washington, he's saying that there needs to be more clarity on the crypto regulatory framework. That's something he said before. He said states could also have a role in crypto oversight, and thus far, we have not had any movement on those. Coming up, the company behind Terra Chips and Greek Gods Yogurt is looking to go global. We'll speak with Hain Celestial's new CEO, Wendy Davidson. That's next. As we celebrate International Women's Day, Hain Celestial is doubling down on female leadership, with women filling both the CEO and chair roles for the consumer goods company. Hain Celestial CEO Wendy Davidson is joining us now in our first interview at the helm. Wendy, welcome. Thank you so much for being here. I was just looking at your board of directors. I was just looking at your management team, and indeed, there are women there. How do you go about doing that in a thoughtful fashion that is recruiting smart women and convincing them to come over to Hain when so many companies seem to either not care or have trouble doing so?
Well, good morning, and thanks for having me this morning. Well, I would say that a lot of this work had been done actually prior to my joining the company. We're lucky to have 44% of our board are female. Almost 40% of our leadership in the company are female. So the company had done quite a bit of work before I got there. But I will say that I think there's a misnomer that there isn't available talent. And when I look back over my career, I've been fortunate to work for some really great large global companies that were very invested in the space, and they gave me opportunities to be able to stretch and grow. I've always believed that when you have a seat at that table, you need to make room at the table for more people, make the table bigger. I think this opportunity at Hain offers me the chance to make sure that our leadership of the company at all levels mirrors the marketplace that we're looking to serve with our brands. And we're fortunate to have some really fantastic brands that actually appeal to lots of consumers. So it's a great time to be at Hain.
I want to ask about board composition as well. And I mentioned that both the chair and the CEO at the company are women, and it's two different people, which is also, I think an example of good governance that not all companies adhere to. But in general, we've actually seen a little bit of setback when it comes to the number of women on boards broadly. And I was just reading some information here that maybe one of the ways to get at that is to not raise or even to bring down the mandatory retirement age, and that way roll off some of the men who are on boards currently. How do you think about that issue? How to get more women on boards?
Well, I think there's multiple ways you can get to it. One is that you mandate it. The other, I think, is that we have talent that's ready to be able to lean into those spaces. And then those women that serve on boards, and I serve on another public board as well, that it's an intentional effort by the board to make sure that we are looking broadly when we're looking at candidates to be able to join to the board. The idea that there isn't available talent, that we're tapping into the same people for those roles. I've been involved in lots of women's organizations, first with the Women's Food Service Forum, and then I serve now on the Next Up board, which is really focused on CPG. There are tremendous numbers of women who are ready to serve in these roles. I think the requirement, less so about mandatory age change, but more about, are we looking for a sitting CEO to sit on the board? Because that automatically will reduce the pool of available candidates. But if we look at people with a broad base of experience to be able to serve, but who bring real operational expertise, then you get the best of both worlds. You get a board that has the makeup of the broader marketplace, and you get people who have actual operational experience across a wide variety of functions and may actually be closer to it than people who are a retired CEO.
Wendy, I'm curious as to what you're seeing with women just beyond the board in the lower ranks at your company, because during the pandemic, many left to take care of children and sort of left the workforce. We are seeing the labor market, which is still strong, and that's been a topic for the Fed. So what are you seeing as far as just women in general in the workforce and the labor force of women?
Yeah, I think you bring up a great point. And so I would widen my answer beyond just Hain. I think the marketplace saw diverse populations disproportionately impacted during the pandemic because they had more people to care for, and that work-life balance really disappeared. I'm actually a big believer that I think coming out of the pandemic, we have an opportunity to set a tone for how work gets done that is different than the operating models that we've looked at in the past that really didn't service people who had young children at home or who were dealing with multiple ages, even sandwich generation. You're dealing with parents as well as dealing with small children. So we have this great opportunity to be able to invent, what does hybrid really look like? How do you bring people together for moments that matter, but give people the flexibility and the autonomy to work in a way that they can best work and fit the various parts of their life together? you're probably in the same boat I am, that you've had lots of people ask about work-life balance as if it's something that's only unique to women. The reality is work-life balance is for all of us, and finding a way for people to live their best life and work, that those two things aren't mutually exclusive, is a tremendous opportunity. And for me, actually coming to Hain is core to our purpose. How do we inspire healthier living for everyone? But I think healthier living isn't just physically what you're eating, but it's also your mental well-being. And so we have an opportunity, I think, to demonstrate what work can look like in the future, which then makes it easier for women to not have to opt out of the workforce, but they can actually be both a great professional and a fantastic mother.
And speaking of healthier living, you offer a variety of products. I actually love your Parm crisps. They are high-end snacks, though. And in your, last quarter, you saw snacks up double digits in the quarter with yogurt that was up as well. So talk to us a little bit about, has inflation impacted at all what you're seeing with the consumer and your brands?
Yeah, absolutely. Inflation's affected everyone. I think we're fortunate at Hain in that we have brands that tend to play in the entry price point of the premium parts of our category. So take Terra chips, for example. It is the lower end of premium chips, but it is in premium chips. So we tend to skew to a consumer that is less recession sensitive, less price sensitive, but we're not at the highest price point. So it really puts us in a great position. I'm also really proud of the work that the team did. Rather than take 100% of the inflationary impact in pricing, they were really surgical in taking pricing where we needed to, and then really driving a robust pipeline of productivity to offset the balance so that we didn't push everything to the consumer or everything to our customers. And that's allowed us to be able to pick up distribution, to be right there with the consumer. And you'll see us leaning into, especially elevating awareness with the consumer on marketing and consumer activation, which we talked about actually in our earnings just a few weeks ago.
That's great. I want to keep buying those Parm crisps. I want the same amount in those bags.
Please keep buying.
All right. Thank you, Hain Celestial CEO Wendy Davidson, for joining us. Coming up, with tax season in full swing, we'll discuss how gig workers may need to file differently this year. That's next. Stay with us. New tax rules are now categorizing more work done on platforms like Uber and Airbnb as taxable income. And those companies must now send 1099-K forms to their workers. Here with more, Caroline Bruckner, Managing Director at the American University's Coca-Cola Tax Policy Center. This segment brought to you by Fidelity Investments. Caroline, thank you so much for joining us. So talk to us a little bit about what the gig economy worker needs to keep in mind this tax season.
Well, first of all, thanks so much for having me. And the number one thing that gig workers need to keep in mind is to track both their income and their expenses. If you're a gig worker, you're a small business owner and you are responsible for filing your taxes. There's no withholding from the companies that you work with that make payments to the IRS on your behalf out of your paychecks. It's all on you. And that means increased record keeping and accounting that you now have to keep track of.
And Caroline, it's Julie here. The threshold is different now, right? In terms of above what level you have to report that income?
Right. So for a very long time, the threshold for big companies, platform companies like Uber and Etsy and Lyft to send information reporting forms to the IRS and their workers was when a worker had more than 200 transactions and $20,000 in payments. But Congress changed those rules to take effect for 2022 and lowered the threshold to $600 in payments that would then trigger this information reporting form to get sent to the IRS. But there was a lot of controversy over implementing this new lower threshold because, frankly, a lot of companies weren't ready or able to implement this new rule change. So late in December, the IRS announced a delay of the reporting threshold, and the new information reporting forms will now go out next year at the lower $600 threshold. But that doesn't mean your tax rates changed, and it doesn't mean how much you actually owe changed, because as I said earlier, it's all on you to keep track of your income and your expenses, regardless of the form you get.
So let's say that I moved and I sold all my furniture on Facebook and I've received more than $600 for that furniture. Then you're saying I have to go back and report that as income. Facebook is not going to put it through for me, but Airbnb I think does. I believe that Airbnb does keep track of that, right? Or is it different with different companies?
Well, it's different kinds of income. So if you sell stuff that you bought and you sell it for less than what you paid for, that's generally not taxable income to you. And it is on you to make sure that you have receipts or record keeping for what you paid for it and then what you sold it for. Now, if you are in the business of selling goods and services, that's a different story. But if you're doing a garage sale or selling stuff online at a loss, then what the IRS has done is put out FAQs and guidance for taxpayers on how to report that income if, in fact, they do get a 1099-K for that income. Here's the catch. That income is probably not taxable, and you might not get any kind of 1099 for that income this year. Next year, it's a different story.
Oof, a lot of stuff for people to keep track of if they are selling stuff online, working for themselves, gig economy, all of that. Caroline, as always, it's great to catch up with you. Hope to see you again soon. Caroline Bruckner, Managing Director at the American University's Coca-Cola Tax Policy Center. Coming up, Rochelle Akuva has you for the next hour of trading, including a conversations with Siemens USA CEO. That is in the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this hour. Fears of higher rates see yields rise and stocks struggle to recover from their sell-off. It's all to play for on day 2 of Jay Powell on Capitol Hill, though. Will he throw markets another curveball? We'll discuss. And House Republicans slam the FTC over plans to depose Elon Musk as part of a probe into Twitter. Free speech, data security, and the so-called Twitter files come right back into focus. We'll get into that story as well. And we'll speak with author, radio host, and serial entrepreneur Randy Zuckerberg on making a name for herself in the tech space. We'll get her views on all things crypto and what it takes to be a fearless leader. But first, let's take a look at how the major indices are faring. A mixed picture here. We're seeing the Dow there off about 96 points there, but still a far cry from the sell-off we saw yesterday. The S&P in the green as well as the Nasdaq both pushed up by some of the buying that we're seeing in the tech space. The S&P there up just fractionally though, just barely 2 points in the green. The tech-heavy Nasdaq though up 22 points, 0.2% on the day. Let's also check in on the Treasury market, as we've seen some recession signals continue to flash as the spread between the 2 and the 10-year yield sees the deepest inversion since 1981. So as we can see here, the 5-year down about 0.8% on the day, the 10-year down 1.2%, and the 30-year down 1% on the day as well. Seeing if those higher rates for longer will eventually harm the economy. We'll be keeping an eye on that. Right, turning now to our top story. Fed Chair Jay Powell's market commentary continues today with the House Financial Services Committee. Let's get the latest with Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Hey there, Rochelle. That's right. Fed Chair Powell testifying right now before the House Financial Services Committee. His first time since Republicans have taken over the House following those midterm elections. And right out of the gate, House Financial Services Chair Patrick McHenry asking Chair Powell what to expect for the March policy meeting. Powell reserving the right to survey the upcoming data before making a final decision, noting they are not on a preset course. Take a listen.
We have some potentially important data coming up, data to be analyzed. One of them came out at exactly 10 o'clock. That would be the JOLTS report, which of course I haven't seen, being sitting here at 10 o'clock. But we're also getting a jobs report on Friday and a CPI and PPI inflation report next week. So those will be important and we'll scrutinize them. When we say that we're going to be looking at the totality of the data, which is what I said, that does include these reports yet to come. They're going to be important in our assessment of the higher readings that we have very recently received and of the overall direction of the economy and of our progress in bringing inflation down.
Now, Democratic ranking member Maxine Waters took the opportunity to go after Republicans on the debt ceiling and asked Chair Powell about the failure to raise the debt ceiling. Powell warned the Fed cannot protect the economy from brinksmanship or default. Take a listen.
No one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here. But no one should be thinking that we have the tools to protect the economy from all the potential effects of that.
House Republicans also expressing concerns about reviewing and potentially increasing bank capital requirements. Chairman Patrick McHenry questioned the Fed's motivation for the Fed's review and said the central bank shouldn't operate in the shadows, especially when the regulation in question could have broad and significant economic effects. McHenry also accused the Fed of laying the groundwork for climate policy to be implemented through Fed regulation. We are getting more headlines out of this hearing, and I will bring them to you as I hear them. Rochelle?
And Jennifer, I mean, we saw how markets reacted yesterday to that testimony from Powell. What are the expectations here? I mean, I think he's been pretty consistent in terms of staying the course, doing what he has to do to keep inflation, to get it down to that 2% target. But do you think he's doing enough? Is it hawkish enough, do you think, that it's really sort of reset the market expectations?
I don't know how much more hawkish you could get at this point. I mean, he's opened the door to a 50 basis point rate hike in a couple weeks from now after having slowed down to 25 basis points last meeting. And that's on account of this stronger than expected data that we've seen over the past month. And he's reserving his right because, as he said, we've got a jobs report out on Friday. We've got CPI out again next week. And those could come in strong as well, in which case the Fed wants to have the optionality to pivot if necessary. He also laid the groundwork yesterday and again reiterated today for raising rates perhaps higher than previously anticipated. They really want to make sure that they get inflation back under control here. And I think the market's finally starting to tune into that. I would expect Powell to continue to stay the course on what he said yesterday and what he said so far today. I wouldn't expect increased hawkishness, if you will, from this point or any pullback.
Well, we've certainly heard plenty from Fed Chair Powell, and we know they're going into their quiet period soon ahead of that meeting at the end of March. Thank you for that update. Jennifer Schonberger there for us. Yeah. Right, well, we just heard some sound there from Fed Chair Powell on the market landscape. We'll be having more of that just ahead. But for now, we want to get to the tech focus here. And we're going to be talking with Laura Martin here, Needham & Co.'s senior media and internet analyst. Thank you so much for joining us. So, I mean, we have this rate rising environment. We have what we're seeing with the yield curve. I mean, we're still seeing very high tech valuations. Yet year to date, tech's still doing well, one of the top performing sectors in the S&P. Do you have some top picks in this very strange environment?
Sure. I really like Apple here because it's got $90 billion a year of free cash flow, which makes, and as other companies get more distressed under the rising interest rate environment and their cost of capital is going up, that makes it a better acquisition market for Apple. So that would be my top pick in this environment.
And what sort of criteria are you using when deciding? Obviously, not all tech is created equal. Some companies have some internal issues as well. What sort of criteria are you using at the moment?
So mostly as discount rate goes up, companies that don't make money in today's world, their future cash flows get discounted back more harshly into a lower value. So my criteria right now is maximum free cash flow in 2023 and 2024. And by that metric, these big and liquidity, you would like liquidity in case something goes wrong so you can get in or out. Apple and Google both have very strong free cash flow. We would be less positive on Meta. We haven't underperformed because it's under, revenue declines, and that means its margins and its free cash flow are shrinking every single quarter, year over year.
And we know that recently you were in DC getting really the pulse of what's happening with regulation with tech, especially the FANG stocks. In terms of who's doing the best job navigating their alliances and really getting their priorities heard, you said Google doing the best job, Meta doing the worst job. Walk us through what they're doing differently to sort of get this impact.
Yeah, so I'm a visitor to the Washington, D.C. ecosystem, and they are all experts in that ecosystem. And so what they said was, when you go in and try to argue your own case, it appears self-serving if you're Google or Amazon or Apple. But if you fund, think tanks or fund independent agencies and you ask them for a topic that you're going to turn out well, and they write the white paper, and then they go to Washington, D.C. and say that Google is the champion of, for example, small business, that's really effective. Even though it's a Google-funded study, it's about a broader topic that actually policymaker cares about. That's an effective way to get policymakers to back off hurting you. And so that's what Google does really well. They're really good at using alliances and other third parties to, figure out ways that Google is helping the US economy. Meta is just perceived as missing the plot. They don't read the room well. They don't really understand the DC issues. And so they just don't do a good job because of ineffective execution in Washington, D.C., according to the people I spoke with, which was a small sample.
And you also talked to this idea of sort of the metrics that regulators are using in determining who they scrutinize. And size seemed to be one that came up, which is an interesting metric here. But you're really saying that perhaps regulators might not be getting the full picture, especially since we saw less attention as Meta's market value then fell. So talk about that dynamic and what you think regulators perhaps might need to hone in on to get a full picture when they're trying to figure out who to scrutinize.
Yeah, investors will find this impossible to believe, but I heard from two experts in Washington, D.C. last week that Meta has become increasingly not important as its market cap is halved. That when it was $1 trillion, regulators really wanted to regulate it. But now that it's like $500 billion, now it's $500 billion, they don't think it's as big a threat, which makes absolutely no sense from any kind of economist or economics point of view. But that, they're lawyers in DC, so I guess they have their own frameworks.
And I want to ask you about some of the antitrust issues that have been coming up, because, I mean, there's been a lot of discussions around it, but the actual laws on the books haven't really changed to adapt to how broadly some of these tech companies are now spreading into different avenues. What are some of the most significant antitrust issues that have been being discussed?
It's really interesting. So the laws on the books are like from the Sherman Act and the Clayton Act, and those are the laws on the books. So, and then there's this policy debate going on in Washington, D.C., including sort of being spearheaded by the FTC, the Federal Trade Commission. And they're trying to rethink, so historically antitrust laws has been, are we lowering consumer price? If a merger was going to happen and it was going to lower prices to the consumer, it was approved. But now they're thinking through lots of policy issues about maybe if it hurts other companies the way Amazon does, then it shouldn't be approved. Even if you bought it, it would lower price to consumers. Maybe that shouldn't be the standard. Maybe it should be putting other companies out of business should be the standard. So they're having all these talks. But the problem is, for example, the FTC tried to block an acquisition Meta was making. The courts threw it out because the laws on the books are the laws from a long time ago. So there's nothing in writing about these new policymakers. So the FTC thinks new policy should be made, but until there's laws on the books, the courts are upholding the old laws. So all the regulatory agencies are going to lose in court when they try to, argue things on these new metrics of antitrust, because they aren't laws. So the legislature, meaning Congress, has to actually make a law before the policy can be implemented in the courts and upheld. Otherwise, all those old laws apply and consumer standards continue to reign supreme.
We'll be keeping an eye on the M&A space then until we do see some changes in those laws. Needham & Co. Senior Media and Internet Analyst Laura Martin, thank you so much for joining me this morning. All right, coming up, we dive back into the comments from Fed Chair Powell. Stay tuned. The FTC's investigation into Twitter is intensifying. The agency is questioning whether the company is able to properly protect user privacy in the wake of mass layoffs ordered by Elon Musk. For more, I'm joined by Yahoo Finance's own Dan Howley. Hey, Dan.
That's right, Michelle. We saw the number of employees at Twitter plummet shortly after Elon Musk took over, halving the number of workers at the company. And since then, it seems that layoffs have only intensified. According to a report by CNBC, there's about 1,300 active workers at the company right now. And of those, only 550 full-time engineers. So that's kind of perhaps why we've been seeing these troubles at Twitter. You'll remember the other day, the ability to post things like photos, videos, even links was taken down because of an issue with an API. There have been other outages throughout this early part of the year. And so it looks as though they seem to be running into walls because they don't have enough employees on hand. Now, Elon Musk says that they should break even this year if they continue to work at the pace they're working. But you have to wonder what that means then for the service itself, as well as new features that could run out that could potentially make it more profitable. And then, oh yeah, do advertisers then trust the service? Because look, if you can't post a photo or a video or a link, then what's the point of even advertising on Twitter? Your content's not going to be seen. So I think this is going to be something that Musk is going to have to continue to deal with when he's not tweeting himself.
Indeed, and that is very rare. He does seem to stay quite busy with that. Dan Howley, thank you for that update. Of course, we just heard some sound from Fed Jay Powell on the market landscape ahead. So joining us now is Marianne Bartels, Managing Director and Chief Investment Strategist at Sanctuary Wealth. Thank you so much for joining me, Marianne. So obviously,
thank you for having
we heard
me.
from Jay Powell. Of course. We heard from Powell that he's focusing on a number of things. Obviously, the JOLTS data came out while he was already testifying, but you have the jobs report out Friday, CPI, PPI, retail sales data coming out in the days ahead. How are you positioned? Obviously, the Fed is still trying to make up its mind about a 50-point basis hike at the next meeting.
Well, what we've been telling our clients is that as long as the Fed is raising rates, asset classes like equities and fixed income are going to remain volatile. And what we got out of the testimony yesterday is the likelihood that the Fed's going to go back to an increase of 50 basis points. But I have to say, given that expectation, I thought the equity markets handled that new information quite well. Yes, they were down, but if something like this had happened, back in 22, I think the markets would have been down like 3%. And we actually saw risk assets like Nasdaq outperform the S&P. So yes, the markets are digesting that rates are going to continue to go up. They're going to stay higher for longer. But I feel that the market is really well positioned for that. I think where the risk would be is if they continue to press rates and then rates eventually go to 6%. That's kind of been our target where, asset classes won't be as happy.
Indeed. I mean, we're looking at some of the commentary here. We know that Citi is expecting that 50 basis point hike at the Fed's March meeting, with the terminal rate raised to between 5.5 and 5.75%. Goldman, a similar range for them as well. They're also expecting an additional rate hike in July. What are your expectations in terms of the pace of the rate hikes and the size that we're expecting this year?
Well, I have to say that the Fed has been very good at communicating that they're data dependent. And they're going to react based on data. And the data that's coming out is having inflation really not go down. And employment, I think, is they say inflation is sticky. I think employment is a little sticky because, as you mentioned, we got JOLTS higher than expected. We got ADP higher than expected. In addition to that, the revisions were higher. So the data is a little bit stronger than the Fed wants. So they're going to react to that. But I think that's why the market is acting so well. If you looked at 5-year break evens yesterday, they came down sharply. They're happy that the market is starting to price in 50 basis points. And as I said, I think equities handled it very well. The front end of the curve did what it was supposed to do. It was going to go up. And you are seeing, the yield curve flatten out even more, the worst since 1981. And what I feel is happening is you have a fight between monetary policy and a fight between fiscal policy. And because we had such great stimulus during the COVID period, and we're having fiscal stimulus from President Biden, you have the CHIPS Act, you have the Inflation Protection Act, that we don't really have models to understand how to model all this stimulus. even though the Fed has been tightening now for almost a year. And I think this is important. Coming up on March 17th, this is going to be the 1-year anniversary that the Fed began to tighten. And as many of us know, there's a lag to monetary policy of 12 to 18 months. So we're really just moving into the period where we're going to start really feeling the effects of the rate hikes. And we probably don't talk enough about quantitative tightening or the roll off of the balance sheet. So I think as we move into 2023, we'll have a better idea of how the rate hikes and the quantitative tightening has actually impacted the economy.
Because when we did hear from Powell, he was saying that he didn't think that they tightened too fast or too much at this point. But you have Bank of America Chief Executive Brian Moynihan predicting a very slight recession beginning in the third quarter of this year. But as we keep an eye on things like the inverted yield curve, what are the signals telling you? Are you also expecting a slight recession, and will it happen this year versus what we'll perhaps see next year?
I think, as I said, because of this fight between monetary and fiscal policy, we're having a hard time predicting when the economy is going to slow down. What we're watching as a barometer is initial jobless claims, because the part of the economy that remains very robust, which is what Powell talked about yesterday, was employment. And they want this to slow down. So I think the leading indicator that will help us be able to determine when the economy will begin slowing down is by watching initial jobless claims and then watching employment every month. So it's definitely months away before we have probably official recession. But of course, the NBRE is the one that actually confirms whether or not we've been in a recession. And many times we don't find out we've been in a recession until we've been in it for quite some time or since it's passed. So I think it's going to be quite some time before we even know if we're officially in a recession. But definitely watch employment as the key barometer as to Fed policy.
And so, Marianne, we've seen over the last year the 60-40 allocation model really been hammered by a lot of analysts. You say it's making a comeback, and you also say in this bear market, you see buying opportunities. What is your strategy in this environment then? What opportunities do you see?
Right. So we see opportunity. There's always opportunities in any kind of market cycle. It's about finding them. So in terms of 60-40, because for 14 years, we really didn't have interest rates, we couldn't get, a good amount of income. We had TINA, there is no alternative. Everybody went into equities and wasn't really well diversified. It was never going to be easy to go from a zero interest rate environment to where we are now. There was going to be pain. And we've been through the pain. We may have a little bit more as we're probably getting close to the end of the Fed tightening. But now you can really build out a portfolio with stocks, bonds, and cash. We're seeing great demand from our client base to really go after some of these high yields that are now in the 5% range in treasuries. In terms of equities, you really want to be selective. We think the pocket that you really want to continue to avoid is what we're calling the mega cap tech. But if you really look at part of the cyclical part of the market, if you look at industrials, they're doing really well. Aerospace and defense, parts of machinery are doing well. Parts of transports are doing well. And we think this has a lot to do with the infrastructure bill and the spend that's happening. Semiconductors within tech are doing well. That partly is due to the CHIPS Act and the investment that's going into that part of the market. So you really want to hone in on specific areas. We also like small and mid cap, very well priced relative to the S&P 500 and very well priced relative to history. So you really want to be diversified. You want to stay with quality, and you can really build out a portfolio of stocks, bonds, and cash.
It certainly seems like time to go shopping there. But as you mentioned, they're being selective in the process. Marianne Bartels, Managing Director and Chief Investment Strategist at Sanctuary Wealth. Thank you so much for joining me this morning. All right, well, checking in on the markets here, sponsored by Tasty Trade. We're still seeing a mixed picture here with the Dow under pressure there, but just slightly, about 0.25%, down about 80 points on the day. The S&P 500, though, still in the green, though, still gaining about 5 points now, so some accelerated buying we're seeing. The Nasdaq also seeing some gains here, up 40 points as we head into this 11:30 part of the show. All right, coming up, closing the gender gap in the tech industry. We're joined by Randy Zuckerberg next to break down the latest digital trends that are helping women make a larger impact in the field. Stick around. It's International Women's Day, so let's turn now to women in tech. Now, women make up roughly half of the workforce, yet they are significantly underrepresented in tech, holding 28% of the jobs in the sector. Well, now the acceleration of digital trends looks to be an opportunity to close the gap. Joining us now to weigh in is author, radio host, and serial entrepreneur Randy Zuckerberg. Randy, great to have you on the show. So I want to ask you, because obviously when COVID came about, people working from home, sort of hybrid work as well, a lot of people thought this was really going to help level the playing field when it came to some of these digital jobs for women. But what are you seeing?
It's interesting. I think that the remote work, it both created new opportunities, but also a lot of new challenges. Unfortunately, what we saw during the pandemic is that a lot of women stepped out of the workforce because we kind of went back to traditional roles in households where with schools shutting down, a lot of women were doing double duty and leaving the workforce. So we're still playing a bit of catch up from that. On the remote work front, like you mentioned, that opened up a lot of opportunities. You could work from for any company, no matter where you were, but it also made the workday on average 3 hours longer when we switched to remote, which definitely had some repercussions for women.
I can definitely say that working from home, yes, you do have those extra hours built in before you know it. An entire day, 10, 12, 14 hours have gone by and it feels like you haven't stopped. So I want to talk about then where we go from here in terms of the future of tech jobs. When we look at how they're growing, projected to grow 15% by 2031, how can women better position themselves to really take advantage of those opportunities?
Yes. Well, one of the things that I've always loved in my career is being on the front lines of new emerging industries, because I think you have a choice getting into a tech career. You can either spend your time playing catch up in an already male dominated part of the industry, or you can get in on the ground floor of some of the emerging things that are happening. And there's so many exciting things with cybersecurity, space travel, blockchain, artificial intelligence. These are all opportunities for women to get in on the ground floor. But a lot of it does revolve around educating and upskilling yourself. It involves stepping out of your comfort zone a little bit and being prepared to step into the unknown. And that's something that I really hope more women will consider doing.
And one thing we did see, a lot of more women stepped into entrepreneurship. I mean, we know that you went from the front lines at Facebook, now Meta, to being a serial entrepreneur. Is that perhaps a way for more women to get into this space if they're not really getting the opportunities that are clearly out there, but they don't seem to be able to get hold of these opportunities?
Yes, and that's one of the areas that we've seen tremendous growth is in startups, of women founding startups. We're seeing more and more women that are founding kind of unicorn level, $1 billion plus startups, more women on the investing side. That being said, though, the numbers are still pretty bleak over there. Also, less than 2% of venture capital funding this past year went to female founders and CEOs. And what we've seen is that when you are a founder of a company, you hire people you're familiar with, who think like you, who look like you. So if 98% of funding into the tech sector is going to men, then that's going to perpetuate who continues to work for the tech sector. So I think it's really important that more women found companies and that they get the funding that they need for those companies to be successful.
So to that end, then I want to ask you about this partnership with DeVry when it comes to this Tech Scholars Program. Talk about the goal of this program and the sort of success that you're hoping to see here.
Yes, well, in honor of International Women's Day, I've had the pleasure of working closely with DeVry for several International Women's Days now. We share a deep passion for getting more women into tech careers. DeVry University has a Women and Tech Scholars program that surrounds women with other women, with mentorship, with professional hands-on experience and credentials, and is really designed for women at all stages of their career who want to kickstart a new career or an expanded career in technology. So I think programs like this are absolutely essential to moving the needle and getting more women into the tech industry.
Now, obviously, crypto has been in the headlines a lot, not for the best of reasons, as we've seen, obviously, the fallout from FTX. I want to talk about this Queen of Crypto title that you have. Can be a tough crown to have, especially at a time like this. But talk about your advances in crypto and Web3 and really the opportunities that you see for women and some of the barriers that still exist.
Yes, well, certainly it has been a roller coaster ride to be involved in crypto. But what I will say is that there are several areas of crypto and Web3 that I'm really passionate and excited about. Whatever happens with the individual cryptocurrencies, I am extremely excited about the underlying blockchain technology. I'm even more excited about what Web3 means for the creator economy, for anyone who's an artist, a content creator, a media creator, or a producer who wants to have a direct access and monetization with their community. And so those underlying technologies are not going away, no matter what happens with crypto. And I think this is actually a perfect time for more women to at least understand what's going on in these industries, so that they can have a seat at the table as things pick back up again.
And of course, I do have to ask you, as the sister of Mark Zuckerberg, obviously you had a front row seat as that business was being grown. But in terms of the fearless leaders that you look at, especially coming from that background in Meta, who do you see then as some of the icons in business that you really look up to?
Yeah, gosh, I've been lucky to be surrounded by incredible female leaders. And as I've pivoted my career in and out of both technology and the arts, I have to say that there are a few things that I've learned. A is that there are so many groundbreaking women around me. I mean, I had the pleasure of working next to Sheryl Sandberg when I was at Meta, which was an incredible experience. I've had the pleasure of producing almost a dozen Broadway shows that are written by women, groundbreaking women who are Anais Mitchell, who I just produced, was only the fourth woman in Broadway history to write her own solo show. So I've been fortunate to surround myself with incredible women, and now at the front lines of Web3. But we desperately need more of us at the table, especially a lot of these new technologies that are coming out have real societal and ethical questions that they're raising, and questions around how our children, how we'll all be interacting with technology. And if women don't have a seat at the table right now, we don't get to have a voice in what happens with those.
And that's a very important point there. You don't want to be on the tail end of that, some of these decisions being made for us instead of involving us. I do appreciate you joining me this morning. Author, radio host, and serial entrepreneur Randy Zuckerberg. Thank you so much. All right, coming up, Siemens is expanding its manufacturing footprint with a $220 million investment in the US. We'll talk the latest with CEO and President Barbara Humpton next.
Inflationary pressures are running higher than expected at the time of our previous FOMC meeting. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Congress really needs to raise the debt ceiling. That's the only way out.
You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. We are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Expanding its manufacturing footprint with a $220 million investment into building a North Carolina rail manufacturing facility. Yahoo Finance had the chance to sit down with Siemens USA CEO and President Barbara Humpton on the company's contributions in advancing U.S. infrastructure and the impact on communities. Take a listen.
This is such an exciting day. You know, first, Siemens in the USA this is Siemens' largest market, and we are so proud to have invested over $3 billion in the US over the last 4 years. So this is a continuation of our commitment to the US market. And what you're seeing here is the establishment of an East Coast rolling stock rail manufacturing location. We'll be beginning with passenger trains and looking forward to all of the growth that's ahead.
And this really does give us sort of a bit of a preview as to the future of railcar manufacturing. Talk about what that looks like versus what's currently on the market or the industry standard today.
Well, you know that the future is more electric and connected. We know that we need to be driving to all kinds of clean forms of power. So the rail cars that Siemens manufactures today, many of them have their own built-in power, some of it battery. We're moving toward hydrogen as well. And so we can expect to see the introduction of those new technologies, not only with Amtrak, but also with other transit systems. I'll tell you what, Rochelle, though, the thing I'm most excited about is the potential for a future of high-speed rail in the US.
And certainly when you look around the world and you see how far some of those advancements have come, you know, it's good to see now the US taking a stronger lead here. I do want to ask you, because it's not just investing in rail infrastructure, it's also an investment in the community. This is going to come with about 500 jobs created through 2028. Talk about that investment in the community and what this means when we really think of what American infrastructure is now versus when we traditionally think of what roads and bridges and things like that.
That's right. Yeah, and this is where Siemens is focused, with this combination of the real and the digital world. We combine the two, and we're bringing technology into the infrastructure that's all around us. Think of us as an industrial technology company, but you know what? The technology is only as powerful as the people behind it. So this selection of Lexington, North Carolina had a lot to do with the community itself. The people who are here, the educational system that's all around us, the power of the community college system in North Carolina are all factors in choosing Lexington as the home of our new rail facility. You know, making the jobs of the future available to communities such as this that had been hard hit when textiles and furniture manufacturing moved overseas. Now, with investments by customers in the rail industry, we're able to bring jobs here that are going to be the leading jobs of the next century.
So talk about some of the investments that you're making, because at the moment we're seeing a lot of companies pulling back on investing in partnerships. But over the past few years, especially over the past 4 years, Siemens has instead really stepped up those partnerships and investments. What are you prioritizing at the moment?
Yeah, and I'll tell you why we're investing right now. It is because we have a real transformation going on. We know that for years we've been needing to invest in the nation's infrastructure. And so with the passage of the bipartisan infrastructure law, now we have the down payment from the federal government being augmented by the investment of private companies and state and local communities who are all rebuilding the infrastructure that they need. So what we've focused on at Siemens really is, if you look across the board, you'll see this focus on transportation with mobility in passenger rail, light rail, as I say, hopefully the future of high-speed rail. But you'll also see us in cities working on connected buildings, working at the grid's edge, bringing the software power of microgrids to help transform the two-way flow of electricity, unlike anything that's ever been possible before. And look for us in this resurgence of manufacturing, because as more manufacturing is brought back to the United States, then we have the ability to set up new greenfield manufacturing locations. All of those can be set up using the latest tools. The digitalization of manufacturing makes a huge difference.
And we know that the future of U.S. infrastructure, especially front and center, we have Norfolk Southern CEO testifying in front of the Senate this week on Thursday, especially after these unfortunate incidents that have not just had an impact on the rail services, but also the environmental impact as well. Talk about how that incident has really affected the conversations that you're having in your community.
Well, first of all, safety is a top priority across this entire industry. And our voice, the way we're using our voice in the discussion today, is to help people understand the power of technology to help us in the analysis and risk avoidance. I just heard a story today from one of our rail leaders who shared the news of a locomotive that badly needed maintenance, and the driver hadn't seen the need for it, but there's a command center where, because we have the digital sensors on the train, the remote notification was possible. It's this kind of use of technology that we believe will be part of the solutions to ensuring the optimal safety of our rail systems.
Barbara, obviously, with a lot of this advanced manufacturing that's needed for this also requires an advanced manufacturing workforce as well to be able to sustain it. What are you seeing in terms of the skills gap, or perhaps any hiring issues that you're noticing in really trying to build the infrastructure of the future?
Well, we know that everyone is looking for good, strong workforce, new folks to bring into the workforce. And so what we've been doing at Siemens is investing in particularly what we've been thinking of as the middle skills, those jobs that require more than a high school diploma, but perhaps don't require a full 4-year degree. And using our experience as a German company with our knowledge of how apprenticeships work, we've been bringing that kind of earn while you work, earn while you learn kind of approach to the workforce development in the United States. And we're seeing fantastic progress as states begin to develop high school apprenticeships. So bringing young people into the workforce as early as possible, and then actually bringing people in from the sidelines, offering special training programs for veterans who might really thrive in the kind of environment we're in. Overall, the most exciting thing I see happening is the application of our digital tools. We've just demonstrated here in Lexington how we'll be bringing a virtual training program for welders. And what we've learned is that using these virtual tools, it's safer, and we can train people 6 times faster than is possible in the old-fashioned way of actually putting arc welders to steel. So just with the imaginative use of technology and reaching out to communities who perhaps don't even know that these great jobs exist, we're making real inroads.
And Barbara, I mean, you're a prime example, especially in an industry where you don't really get to see a lot of women in leadership positions. So I want to talk to you just about that sort of that rise through the ranks. And as you have that pipeline of young people coming through and looking at Siemens as an example, what is really the legacy that you'd like to leave right now?
What I hope to leave is a legacy in which our industrial technology company is one where anyone can feel like they belong, because belonging is what really transforms. Every stage along my career, I found myself in rooms of people who looked very different than I did. But I always felt like I belonged because I was dedicated to the mission, they were dedicated to the mission. We're a company that works on technology with purpose. And I know it's just like a giant magnet for talent. People want to be engaged in building a cleaner, more sustainable future, a more equitable future. And if I'm successful in my role, there's going to be a seat at the table for anyone who wants it.
That was Siemens USA CEO and President Barbara Humpton with many insights on the state of US infrastructure. All right, coming up, Yahoo Finance's Company of the Year, Costco, is planning to open its 3rd warehouse location in China this Friday. We break down what this means for the retail giant as well as its competitors. Stay tuned. President Biden welcomes European Commission President Ursula von der Leyen to the White House this week with the goal of settling tensions over Biden's recently passed Inflation Reduction Act. For more on what they hope to achieve, Rick Newman joins us now. And Rick, we know this caused some tensions when this first came out.
Yeah, Europe is usually ahead of the United States in terms of industrial policy and government incentives for homemade companies. And the United States kind of jumped ahead of Europe with the Inflation Reduction Act last year, tons of incentives for green energy production. That includes automobiles. So a lot of European automakers are now saying, hey, we want to maybe do more development, open more factories in the United States to take advantage of those subsidies, including battery plants, electric vehicle battery plants. And you got some governments in Europe saying, hold on a minute, not so fast. We need to even this out. So we don't want a trade war between the United States and Europe. We tried that under President Trump. It did not work out so well. And it's important for both sides to more or less have a solid trade relationship. So that's one of the things they'll be talking about is how can Europe catch up with some of these new incentives here in the United States.
And it's tough. You know, a lot of people trying to wonder if they should be collaborating. There's also some rivalry, and especially when it comes to these high-tech technologies of the future. But also want to turn now to President Biden's troubles right here in Washington. Republican lawmakers pushing for the release of documents about Biden's son, Hunter. So what's behind these demands?
Right. And they want documents from the Treasury Department that would answer the question of whether the Treasury Department ever saw anything suspicious with regard to Hunter Biden's bank accounts, any large wire transfers or anything like that. I mean, there are rules that require banks to disclose these things to the government if it could be money laundering or if it's above a certain threshold for in terms of dollars. So Congress wants to know, does Treasury have any information like this about Hunter Biden? And the Treasury Department has said, you know, we're not sure we're going to tell you that. And what does this bring to mind? Of course, it makes me think of when Democrats ran Congress a couple of years ago, them trying to get Donald Trump's tax returns from the IRS. And of course, they did get Trump's tax returns. He objected and it went to court. And the courts finally found, yes, Congress does have a right to see Trump's tax returns. Now, the Republicans who control the House now, not clear yet whether they will actually try to sue and go to court to force the Treasury Department to turn over anything it has on Hunter Biden. But if they do go that route, I think we can expect to see the Treasury Department say, we'll see you in court. And of course, this would take many months and probably years to work out. So long fight ahead, most likely.
Indeed, and certainly it'll be long past the 2024 presidential election to see any sort of impact there as these lawsuits drag out potentially. Rick Newman, thanks so much. All right, well, Costco plans to open its third warehouse location in China this Friday. Yahoo Finance's Brooke DePalma is here to discuss the details and why now makes sense to expand its presence there. So, Brooke, break that down for us.
Well, good morning, Rochelle. That's right. Costco is expected to open its third location in China near the Disneyland Resort in Shanghai. Now, this comes nearly 3.5 years after we saw that first physical location in China open in August of 2019. That was met with essentially pure chaos after 200,000 members signed up, surpassing its goal of 100,000. And now, as China emerges out of the COVID-19 pandemic, we saw those lockdowns go away, and the Chinese government expects GDP to rise around 5% this year. We're seeing a pretty resilient Chinese consumer. And so Costco making yet another play here with its newest location. And so taking a deeper dive into who exactly that consumer is. Well, in China, we're seeing the rise of the middle class. According to McKinsey, we're seeing double-digit growth of upper, middle, and high-income households, really powering a robust consumption growth there. In addition to that, Arun Sundaram of CFRA saying that consumers are, quote unquote, very receptive to membership-only warehouse models. And maybe that wouldn't have been the case necessarily 10 to 15 years ago. And the demand for imported products, Chinese consumers certainly seeing Costco as highlighting Western products. And so Chinese consumers really intrigued by Costco overall. And so with this third location, lots of excitement around it.
And Costco, of course, not the only game in town. So how does Costco's presence in China compare to, say, Walmart's Sam's Club?
Right, Rochelle. Well, let's make it clear here that Walmart Sam's Club really does have a more robust presence in China. They opened up their first physical location back in 1996. Now, this last fall, they opened up their 39th location. And in that release of the 39th location, they said that it demonstrates their commitment to accelerating and deepening its growth throughout China. So certainly doubling down on its presence there as Costco looks to make a deeper play. Of course, it's set to open that third location this week. It plans plans to open its 4th and 5th location in the 4th quarter of this fiscal year. And so is Costco making big plays there. And in addition to that, Costco is not necessarily new to the Chinese market. They have been establishing a presence via e-commerce nearly 5 years before they opened up that first location. And so that CFRA analyst said that it's been a slow and measured approach here. They really took time to understand who the Chinese consumer is. With that said, Arun Sundaram of CFRA did say that there's room in the market for both. Given China's overall size, there is essentially room for both Costco and Sam's Club to play nice overseas in China.
Indeed, and certainly important to try and understand what the post-COVID consumer looks like. We know that a lot of US companies still trying to manage that as well. Brooke DePalma, thank you so much for that update. All right, coming up, we take a look at the markets ahead of the noon hour and get you set for what to watch later today and tomorrow. Stick around. Now time for some trending tickers. Adidas, or Adidas if you like, their stock is in the spotlight this morning after the company posted a big loss in the 4th quarter and slashed its dividend for the year as it deals with the aftermath of its failed partnership with Kanye West, also known as Ye. Now the retail giant is stuck with $1.3 billion of unsold merchandise, with the CEO floating several ideas of what to do with all the leftover Yeezy gear. We'll continue to cover top trending tickers and hear from the big names throughout the week, so you want to stay tuned for that. So tomorrow, we've got a full lineup. We'll get a check on the state of cybersecurity from CrowdStrike CEO, as well as the CEO of Zscaler. And we're also honing in on crypto. We'll be joined by Grayscale CEO Michael Sonshine. And that's not all. We'll lighten things up with Mattel CEO on the back of their Investor Day. And of course, very excited about the launch of their new Ariel to coincide with the re-release of the movie. All right, well, let's do a final check of the markets before we go. We see a mixed picture here. Still the Dow, the only one in negative territory, though at least paring back some of those losses, but still down over 30 points on the day, about 1/10%. The S&P 500, though, still hanging on to gains there, just slightly, though, up 11 points or 1/3%. Tech-heavy Nasdaq, they're up 65 points on the day, the strongest performer there, up 0.6%. Well, that'll do it for now. I'm Rochelle Akufo, but I will see you tomorrow at 11 a.m. Eastern. Until then, have a good one.